to be able to sell at a higher price, of course. Then another way we can look at that and is if we talk about even within the mid-range car markets, where we have the Toyotas, the Hyundai, and all that, there may be elements of differentiation, especially Toyota. Now, when we come to focus, is where the company tries to create a niche for itself that maybe not many companies are serving, right? And then either differentiate in that niche market or maybe adopt cost leadership. But mostly the strategy is to differentiate in that market. We also need to understand business model. Business model basically is how organization works to make money, or how do they make money. And the whole idea of making money is to actually create value for shareholders. Once you create value for shareholders and other stakeholders, then you tend to get returns from that. And so the company try as much as possible to define what constitutes value for the stakeholders. Shareholders' value could be in form of dividends, could be from a return on investment. For customers, it may be a matter of quality in terms of the product produced. And for suppliers, it may be in terms of something else, maybe reliable relationships or however the value could be. So at the end of the day, this value get created. A company come up with strategies to get this value created. Then they have this value delivered, then to shareholders and also to other stakeholders. And then they capture the residual value, which is also otherwise called then the gain or the net gain. The whole idea here is that you need to understand the business model of a company. Otherwise, you will not be able to know where their revenue sources are. What are the drivers of their revenue? What are the drivers of their cost? And also, if a company is coming with a revised strategy or a plan for the future, it may have an implication for the business model. Maybe an aspect of the business model may change. And then that may mean that the cost may change. The cost structure may be a company that operates physical shops is now going entirely online. So that is going to affect how the company delivers value. So if that is the case, then you may not have to be paying lease expenses or rentals and all those things again. You may not need people in the shops again. So those cost elements will be off. However, you may now need to pay for digital costs and those associated with the hardwares and the softwares and the associated costs or costs associated with selling online. You see, you need to really understand these things. Now, so that is just basically on strategy, which I just ran through because there are things I believe you know, just for completeness. Let's get into what cost is. So when we talk about cost generally, irrespective of the industry you find yourself, costs can actually be classified into elements or nature or behavior or function. Now, when we deal with elements of cost, it's a matter of the makeup of cost. So we can classify total cost of a firm generally into material-related costs or a labor-related cost or expenses. Now, in today's world, where the world is dominated by service, the material-related cost is actually reducing speedily, and due to ESG initiatives and all that, material cost is reducing. And when the labor cost is also increasing because of humans, however, with machines coming on the scene, is affecting labor costs as well. Of course, you see more of expenses rising rather than labor. I think someone is asking, or someone is stating that he can't hear me. Am I audible to you all? I'm audible. So I know if maybe it's a local issue or it's global. Okay, we can hear. Okay, so I think then that should be a local issue. Okay. Okay. All right. Now, so when we talk about nature of cost, nature of cost is a matter of whether the cost incurred is related to the service or the actual product the company produces. So If a cost is direct, it means that these are costs related to the product the company specifically produces or the services it renders. So if you work for a college or university and you are dealing with, you want to know which is direct cost, which is indirect cost. Of course, the direct cost for a college may be the cost for or are incurred at faculty level. So the salaries of the lecturers for each faculty, of course, those become direct costs. But an indirect cost may be costs incurred at the registry level, finance, and all those support units, right? Those ones are the indirect. Now, when we sum up the indirect cost, then it gives us something we call overheads. Overheads is when we sum up the indirect cost. So each time you hear overheads, some people say overhead cost, we're relating to the indirect aspect of cost. The problem with that is that usually it's not something you can easily reduce. That's why it's a problem. So mainly it is fixed in nature, but the direct cost, because it relates to the actual product you produce or service you render, you can manage it by managing the level of volume of product you produce or the extent of the service you render, right? Now, in terms of the behavior of cost, we have the fixed cost, which is a cost that is fixed over a period, over a particular output level. So when you are within that output range, the cost is fixed. But then when you are outside the output range, then the cost tend not to be fixed. So in economics, you hear the short term, and then you say in the long run, all costs are variable. What it means is that in the long run, year means a time where the company is able to adjust its operations. So as operations are adjusted, then the fixed cost structure may also change. But then while operations still within the range, the existing range, over that period, the cost is considered fixed. So suppose we have a company that currently has operations in only Ghana. Once the company moves outside Ghana, maybe Nigeria or South Africa, then we may need maybe one other CEO, maybe supervising the South African operation, and another CEO in Ghana here, or you may be needing 2 finance directors, whatsoever. Those are fixed costs, right? But then the fixed cost is changing because of the change in scale of operations. Now, variable costs are the ones that you usually understand. It has to do with the cost that varies as per output level. But when we combine fixed and variable costs, we have what we call the semi-variable cost. And most costs incurred by companies are having this characteristic of a semi-variable cost. They have features of both fixed costs and variable costs, right? And if we classify costs by function, and here we'll be looking at the cost in terms of production-related costs and non-production related costs. And in today's world that we have the services industry dominating, we can talk about the service-related and the non-service-related costs. Right. Now, let's get into understanding of cost structure. So you see, cost structure affects a lot of things about a business. It affects the business's cash flow. If your cost is more fixed or is more variable or a combination, would have influence on the cash flows you're having. Now, you see, what determines the value of a company or a value of a business or the value of anything is the benefit you'll be getting. Now, if the benefit or if the benefits are stable over time, the value of the company is enhanced. But then if the benefits are variable over time, then that affects the value of the thing you want to, whose price you want to determine. Now, so if you deal with a company, for instance, the value of a company is influenced by the cash flows. So if the cash flows are variable significantly, then it means the value of the company is going to be affected because there's a risk inherent in the cash flows. And that risk gets translated into the discount rate you're going to be using to discount those cash flows back. And one parameter that captures the risk is what we call the beta, right? Now, so the variability in the cash flows will influence the beta. If it influences the beta, it influences the discount rates used to discount the cash flow, and therefore it influences the valuation of the company. Now, the question is variability good or is the variability bad? Variability is bad because with high variability, we will have a variable cash flow, and therefore you have a lower valuation of the company. every decision taken at a company level, or maybe working for an investment bank on an advisory firm, every decision you take for a company, every recommendation you give, your objective is to maximize the company's valuation. So if variability is going to cause the company's valuation to drop, then you concern yourself with managing variability, or you'll be concerned with understanding whether the company in question has variability inherent in its cash flow. So there are ways we can assess that. Some industries exhibit that more than some other industries. Now, so the variability in the cash flows I've been describing is what we call, in the context of corporate finance, we call it business risk, right? And because cash flow is made up of revenue and cost, if we deal with variability in cash flows and we call it business risk, then it means that the variability or the business risk can be grouped into sales-related risk and operating risk. The sales-related risks have to do with variability or uncertainty about a company's revenue. And the operating risk here has to do with uncertainty about a company's cash flow caused by the relationship or caused by the fixed operating cost. Now, higher fixed cost means higher variability. Of course, this sounds counterintuitive. Each time I make such a statement, that higher fixed costs result in a higher variability in revenue or in cash flow. This is the reason why. You may think fixed cost is fixed. Why should that cause something to be variable? Let's look at it this way. If you have more variable costs, if revenue is rising, the variable cost will rise alongside. If revenue is dropping, the variable cost will drop alongside. So it reduces variability in cash flow. But you will not even notice that much. But then if we have more fixed costs, if revenue is rising, the cost is fixed. So it introduces some variability. In other words, there's a low correlation between the cost now and revenue. If revenue is dropping, fixed cost is still fixed. You see? So that's a source of the variability. Now, so we need to understand what causes sales to be variable. And there are three major items we can talk about. One is elasticity of demand. So the price elasticity of demand. So if demand is highly elastic, it means that a proportionate change in price results in more than a proportionate change in quantity demanded. You see, so it means people on the market are becoming more price sensitive. So if you reduce your price a bit, a lot of people will buy your product. And maybe that may result in people shunning competitors' product. And now you see this high price elasticity on markets that are highly competitive market, where price is what determines whether people should buy the good or not. Now, so if a company is selling generic goods, it's likely to be faced with high price elasticity of demand. But then if this is a well-differentiated good, then the elasticity of demand wouldn't affect the company that much. Now, when you start looking at a company, maybe you want to do a financial model on the company, these are the initial thoughts you need to have. You need to understand the industry. That's why we take time to understand the industry within which the company operates. Now, we also talk about the industry structure. Here, it gets much into the degree of competition on the industry. In the industry, whether the company in question is dominating, as we have MTN dominating the telcos industry. So you can say that even if MTN increase their price marginally, people will still buy. So the variability is not that there for MTN. But then if you look at other telcos players like Airtel, TECO that have minority share of the market, if they reduce their price, we wouldn't really see much impact. In fact, if they increase their price, a lot of people may shun the product. So that is how the structure of industry could actually affect demand for product. And if it affects demand for the product, it's likely to affect the sales revenue. If it affects the sales revenue, then it will affect the cash flows. If it affects the cash flows, then it will affect the valuation of the company. Then a very important aspect is business cycle. You see, the reason why in a lot of valuation work and maybe transactions work and financial modeling, we consider external we consider external factors or macroeconomic factors these days, such as GDP, interest rate, and the reason why we do those analysis. And in fact, in some of the reports you write on your financial model you build or whatever, the reason why you may consider those things as part of your report is this. Number one, the business cycles affect demand. For example, if a country is currently in an expansion phase, demand is likely to rise, especially for some products. And these are products that are non-discretionary, discretionary products, like automobile. Then you think about real estate. So during the expansionary phase of the business cycle, where GDP is rising, you tend to see these various sectors of the economy performing. Now, so if the country is in recession or getting into recession, you see that these areas are no more performing. You see people not buying cars. Of course, people don't have enough money to spend on luxury, even though minority part of the economy may be doing that. But then most people will spend on non-discretionary items, and they may shun the discretionary ones. You will not see a lot of people buying houses and all that. So if you are doing a financial model or building a financial model for a real estate company, you need to understand the state of the economy. Where is the state of the economy? And how long generally would the cycle last? If we are getting into recession, how long is it going to take for us to translate ourselves from recession to growth or expansion? You see how important these things are. Now, so the degree of operating leverage of a company can actually also be determined. And this is basically assessing the level of or the degree of fixed cost on the company's cash flows, or the extent to which fixed cost dominates profitability. Now, that is it for costs. Now we can take our time and look at elements of financial statement. Any question at this point? Let me check the chat box to see loud and clear. I can hear you are audible. You can hear, I can hear. Just want to check this to see if there's any question. Okay. All right. Yes, the training material, I believe you have that. Someone, in order to manage costs, which of the two caused by behavior should be the focus of the finance manager? Which one can be controlled? Generally, variable costs is easier to control. The fixed costs are very difficult to control. One major fixed cost that dominates a bank's, companies' P&L, mostly I've seen, are staff costs and utilities. Now, for staff costs, are you going to be laying the people off? That's how you can reduce it. Now, for utility, of course, are you going to use alternative power? That's how you can reduce it. But generally, fixed costs are very difficult to manage compared to the variable costs. Yeah, so the slides, I believe, will be provided. We'll provide you with the slides. Right, so let's get into our understanding of financial statement. All right. Now, so I know there may be several people here who already understand financial statement, but then I just want to quickly go through these things just to set the tone so that it doesn't look like I'm jumping straight to the very important matters in financial modeling, right? Now, so if we talk about financial statements, actually a structured representation of the financial position and financial performance of an entity. So those are the two words, financial position and the financial performance. Now, so the financial position is reflected in what we call the balance sheet. Now, going forward, I'm going to be using the term balance sheet to denote the statement of financial position. I don't have the energy to go all the way saying statement of financial position. It's just too long for me. So for communication purpose, I'll just go straight and say balance sheet. And then to show the performance of the firm, we use the statement of profit or loss and other comprehensive income, you can say. So that reflects the performance of the company. But also for the purpose of argument and for communication purpose, you hear me using more of income statement. Great. All right. Now, so the other statement here, the statement of changes in equity, the cash flow statement, the notes, and all that are all derivative of these two statements. They are derived from the statement of financial position and statement of profit or loss. Great. For example, we can create the cash flow out of the statement of financial position and the statement of profit or loss, right? Great. So when we talk about the financial statement generally, these are the things we mean. We don't just mean statement of financial position, statement of profit or loss, and cash flow. We also mean the changes in equity. We mean the notes accompanying the financial statement. We also mean comparative information. So generally, when we say financial statement, it's not just about the three statements, but also the notes. However, for the purpose of what we are doing, and a lot I will be talking about, each time I say financial statement, I mean the statement of profit or loss, the statement of financial position, and the statement of cash flow. Great. Now let's get into each of them. Now, we want to get into elements of financial statement. On the balance sheet, so generally we have 5 elements of financial statement. The balance sheet has 3, and the P&L has 2. The 3 on the balance sheet are the assets, the liabilities, and equity. Now, the 3 come together to show the financial position of a company. Another way to say financial position is financial condition of a company. Now, in other words, it's showing the company's net worth. If we take the company's assets and we take out its liabilities, what are we left with? Does the company has a positive net worth or a negative net worth? If we have a positive net worth, of course, we call that positive equity. Net worth, for the purpose of financial reporting, is what we call equity. If it has a negative equity, and that is what is a bankruptcy scenario, where the assets on the financial statement are not able to cover the liability. However, it does not necessarily mean the company is bankrupt. The reason is that the financial statement doesn't show the true financial position of a company. No. It shows the financial position of the company as it is on the books. But we also have another financial position, which is financial position of the company in the light of the market. That is not reflected on the financial statement. And that's the reason why we do valuation. Because if we do valuation, it tells us the financial position from the perspective of the market. Or in other words, it tells us the value of the company's equity, okay, or the value of the company's net worth from the perspective of the market, and not from the perspective necessarily of the books. Over time, the two could adjust, but, well, it depends on the market where you find yourself. They may not necessarily align in terms of what you see on the books and what the market is saying. Because if you take the financial statement of a company and you see their net worth, which is the equity, and it's 1 million, the question is, would the outside markets they be willing to pay 1 million to get that company? So what is on the market, they may be different, right? That's just something to just top of my head. Now, so when we talk about the P&L account, it has the other 2 elements, which are the income and the expenses. The income here generally includes revenue and other incomes. And let me just emphasize that not all incomes are revenue, but all revenue is an income. So revenue is a subset of income, but then there are other incomes. Now, I included some definitions here. These are technical definitions as per IFRS, but I don't think it's necessary for me to really get much into this. So I want to just give you the intuition behind it. So expenses. So expenses, of course, they are actually expenditure incurred just to generate the income in question. But then whenever we measure income, we are looking at what you are generating over a period. Now, not cumulatively. So if, let's say, you are into real estate business and you sold some properties and you are going to be realizing the income over a period of time where there will be repayments over time, and then there will be some interest components of that. Of course, you'll get into those things next week. There are some interest components of that. You can't realize all the interest today because these are payment days that are going to occur later in the future. Some may go outside the financial reporting period. Now, so expenses are incurred to generate income. The P&L tries to match the expenses incurred to generate income to the income generated. And the difference is what we call profit. It can be a profit, it can be a loss. If it is a profit, it means that the company incurred less to generate more. If it is a loss, it means the company incurred more to generate less. Now, so just continuing with this, we get into assets. Generally, we have the current assets, we have the non-current assets. The current assets are called current because these are assets that the companies can, whatever. But then before I get into current, assets are properties, or maybe they are resources that the company can generate some or expect some economic benefit from into the foreseeable future. So if that benefit we expect is or can be enjoyed within the next 12-month period after the year end, then we call that current asset. But then if the benefit to be enjoyed goes beyond the next 12-month period, then that is a non-current asset, right? So we have the depreciable non-current asset, like the one you can depreciate or amortize, like goodwill, the building, the motor vehicle, the plant and equipment, features. The non-depreciable ones like financial assets, land, deferred taxes, and all that. The current assets, we have the trade receivables, income receivable, prepaid expenses, inventories, cash and cash equivalent, and the likes. Great. The liabilities too, just like for the assets that we have the non-current and the current, the liabilities too, we have the non-current liabilities and the current liabilities. So non-current liabilities are liabilities you expect to settle or that will still be outstanding after the next 12-month period. Okay. Then the current liabilities are the ones you expect to settle within the next 12-month period after reporting date or within the next financial year. That's what I mean by the next 12-month period. So we have equity, component of equity, stated capital, share premium. Of course, I've just bundled the rest together and I call them other reserves, right? These are just going to basic facts, of course, which you are familiar with. So I've gotten into detail of each of these, looking at revenue in terms of revenue recognition, criteria, and all that basic stuff here. So this note will be shared, so you have time to go through it yourself to understand some of these few things if you're not coming from an accounting background or you don't have a fundamental or foundations in accounting. Now, that is the first lesson. Just getting into accounting foundations. Nothing much. We've not done anything concerning modeling. Nothing. We're just revising some few terminologies that we'll be using. So when we start using terminologies, it doesn't look like, or it doesn't sound like something you've never heard about before. That's what I've gone through that. Any question? Any question? Any questions? So please, okay, so someone said, I'm an accountant in a manufacturing company. What do I include in my cost of products? Oh, okay. We're going to be covering this soon. We'll cover this. So when we get to cost modeling, so you can ask the question there. If I've forgotten to respond, please, you can ask, you can raise it again. Look into the chat again. What are some of the revenues that cannot be classified as income? No, there's no revenue that cannot be classified as income. All revenues are components of income. In fact, when we talk about revenue, let me define this especially. Revenue is the income generated from ordinary activities, the firm's ordinary activity. So you need to understand a firm. For example, if we deal with maybe a manufacturing company, when they sell their product, the income they get or the whatsoever they get from or the sales revenue from that is what we call revenue. Now, if a manufacturing company decides to sell their delivery van, it's not revenue because the object of the company is not to be selling delivery van. That's why it's not revenue. You get it? However, the profit or loss on that sales is an income, but it's not revenue because the ordinary activity of the manufacturing firm is not to be selling delivery van, it's to sell product. I hope that clarifies that. I think we are good. All revenues are income, but not all incomes are revenue. Yes. I need clarity on the relationship between value of a business and cash flow. Okay, we will deal with this especially on the last day. We're going to look at cash flow analysis and we'll get into free cash flow, even though we'll not do valuation, but we'll get into free cash flow analysis. And so we'll deal with that. I want you to spend more on all revenue and income and not all income and not revenue. Well, I just explained. Thank you very much for the insights. Please explain an end income that are examples of current liabilities. Okay, now let me explain an end income. Sometimes it's called unbilled income. So suppose you are in this same manufacturing business and then people made advance payments to you and you have not yet delivered the goods, because for revenue to be recognized, you must have delivered the goods as per the contract. As per the contract. So if the contract for a foreign customer, the contract is get the goods ready and get it to the port, and that is all. The foreign customer takes it from there. Once you deliver the goods at the port, you are done as per the contract. Then you can recognize revenue. Now, in a case where the foreign customer paid you in advance, that is not revenue. You've not earned it yet until you fulfill the contract. So if at year end, then that amount you receive will be on the balance sheet as an earned revenue or unbilled revenue. Once you deliver, then we pass journals to send it to P&L as revenue. I hope that is clear. The same thing applies to the hotels too. So if you're going to book hotel for a period and then you made payment in advance, if at year end, the hotel cannot classify that as revenue and until the year ends. Another way, if you look at the telecoms, whenever you buy credits, they don't automatically classify that as revenue. No. When you buy airtime, they don't classify as revenue entirely. When you buy bundle, data bundle, they don't classify as revenue entirely, immediately. No. They wait until you are done using it. So the quantity you use is being passed to revenue. Anytime you use a quantity, they pass it on to revenue until you fully use it. So they'll give you a timeline. Of course, this bundle expires in 2 months' time, in 3 months' time. So in that case, if you fail to utilize it by that 3 months' time, you write all to revenue. I hope that clarifies it. Good. And an earned revenue is part of current liabilities because it is something you have not earned. So if the customer, there may be a need for you to repay back, right? So it's a liability. Now, someone asked a question. Just want to quickly address these questions before we move on, but I think they are very interesting. How does semi-variable cost determine the operating risks for a business? And what is a typical example of a semi-variable cost? Okay, so a typical example of a semi-variable cost, you can talk about the entire cost of sales on the balance sheet, on the P&L, sorry, is a semi-variable cost. It has components of both fixed and variable. And also, if you look at the cost of a product on the balance, on the P&L too, I don't know why I keep saying balance sheet, is a semi-variable cost because if you get into it, it has both fixed and variable costs comprising of the cost, right? Now, the reason why is determining operating risks is that semi-variable cost has elements of both variable and fixed costs. So since it has elements of variable and fixed costs, and we know that fixed costs drive operating risk, then it means that semi-variable cost drives operating risk. And operating risk is the variability in cash flow caused by the combination of fixed and variable costs, or caused by your business being dominated by fixed costs. Last question, then I move to lesson 2. Please, how do you go about the industry analysis? I mean, any site, or we do that manually? Oh, okay. So over the entire lecture, I'm going to be covering that. So I'll show you where you get data from. I'll show you where you get your data from to do the modeling. I'll show you where you should be looking for data from. So I'll handle that later. Great. Great question. Great engagement. Let me stop sharing my screen. And so just a moment. Some hands are up, right? I'm not sure the one. If you can type your questions. Um, I okay. I want to give a 5 minutes break. Just a tea break. You can grab a coffee really quick for 5 minutes. So we'll be back 10:45. Let's get back 10:45. And when we are back, you start looking at the preliminaries to financial statement model. Please don't leave the call. If you leave the call, you may not be able to join. The maximum numbers that can be admitted is 300. So if you leave the call, you wouldn't be able, you may struggle to join. So let's get back at 10:45. Great. All right, welcome back. And am I audible? I need to resume my screen sharing. Okay, I have some questions there. Some will be doing CFA program. Yeah, that's great. We can talk about this. Let me see whether any other question there. And the equity, what is the distinction between ordinary and preference shares? Oh, okay. So ordinary shares basically are the true shareholders, right? They have what we call a residual interest. And what we mean by residual interest is that when everyone else is paid, the leftover is given to them. So the preference shares actually have a fixed expectation, or they have a preferential treatment. Usually, the expectation is fixed in terms of the return paid to them. But then these things could vary. And I would say we have a separate session on funding, where we do funding modeling. That will be next week, where we'll be modeling debt and also equity. So when we get there, I think I can explain these things better there. Please, could you touch more on why we include macroeconomic variables like GDP in the model? Well, you'll see some of these things soon. We are yet to get into them. In fact, we've not actually started the modeling work. Great. Am I audible? Am I audible? Okay. Now let's get into some interesting stuff, and we get into the preliminaries to financial statement modeling. And here we are going to cover about 5 learning outcome statements. These are foundational lectures. Very important. Very important. And you'll see things that a lot of people don't do, but which is very important. So here, we're going to explain financial modeling and financial statement modeling, and we're going to identify key transactions that require financial statement modeling, why we do it, right? Now, then, secondly, we will identify and explain the role of financial statement modeling in corporate finance and transactions. Then we'll demonstrate understanding of what I call the Holy Trinity and discuss the various approaches to historical trading analysis. Very important. And we also explain financial statement model construction process and identify sources of data for financial statement modeling. Then the last side, we will outline best practices in financial statement modeling. Now, so let's look at financial modeling and tools. What is financial modeling? You see, we usually have this term, and a lot of people talk about financial statement modeling or financial modeling. And whenever you go online to see, it is more of Excel work and just doing some 1-2 calculations and all that, and maybe doing some self-balancing stuff, blah, blah, blah. Of course, it may be part of financial modeling. But generally, when we talk about financial modeling, it's more of creating a mathematical representation. And that is known as financial model, a mathematical representation known as financial model. And what we do that or use that for is to simulate the financial outcomes based on various inputs and assumptions. So think about this as a machine where you pass in inputs, then the input get processed in the machine, then it turns out result, which is the output. That is what we call the model. So the model actually accepts inputs and assumptions and then produces out the output. Now, you get to realize that the output is not a 3-statement financial model necessarily. No. You see, the output goes beyond just preparing or forecasting P&L and balance and all that. Now, in this program, we're going to be looking at how an output could be like. Output could be ratios, could be returns. We expected after modeling the financial statement, you're able to come up with cash flow analysis. Those are the output results, right? So when we deal with financial modeling, there are 3 things we tackle. We look at getting the right input and assumption in there. Then building the model, which is simpler, then coming out with the output. Now, so the inputs and assumptions are actually the most difficult aspect of financial statement modeling. And so coming up with a model is a matter of you understanding how items on the financial statement relate. In other words, the interconnection between the various financial statements and also the element of financial statement. That's why we've taken some time to go through. So the most important aspect of financial modeling and the most difficult aspect is the input and assumptions determination. What is the correct input? What is the correct assumption to make? Sometimes you can make the initial input and assumptions, then over time you vary to see the impact on the output. And there's a nice word for that. We call it sensitivity analysis. And we can run those things around also simulations and also do scenario analysis and all that. We keep varying the input and output, input and assumptions, passing them through the model and creating variants of output. Okay. Now, so some sample tools used to create that. Of course, I don't want to say I've never started talking about financial statement modeling now. This is just general financial model, right? Now, there are tools you can use for financial modeling. Excel is the mostly used tool in financial modeling and in the world. In fact, spreadsheets and especially Excel is the most used financial modeling tool in the world, right? We also have Excel VBA. We have Python. And of course, when it gets to languages, the use of languages is when you're doing more of advanced work, where Excel may freeze or maybe difficult to use Excel to achieve it, and then codes are written to do the same thing. But then for the purpose of financial statement modeling, the mostly used tool is Excel. Okay. Now that we know what a model is and what a financial model is, which is a mathematical representation that tries to simulate the real world. So the mathematical representation, just like, for example, we come out with the equation for a straight line, y is equal to as plus b. That is a model, right? That each time you want to get y, you pass in the value of s, and then you get y. So the model is the y is equal to as plus b. Now, can we also create a model in accounting that we can pass in values and it gives us an output? We can try several values. We can try putting in several values and see the output will keep giving to us. But then in the context of financial statements modeling, we work with financial statement, items on the financial statement. And it's easier to use. It's easier to build than those other ones. Now, so when we talk about financial statement modeling, it's actually the process of building a mathematical model that represents the company's financial statement. And this includes the income statement, the balance sheet, and cash flow statement, right? Generally, I mentioned that going forward, if I talk about financial statement modeling, I mean the three financial statements. So this model actually helps analysts to, and accountants and whatever profession you find yourself in, and you are using financial statement, it helps you to understand or gain insight into the company's financial health. You also be able to identify trends and also evaluate scenarios for decision making. Now, so when we talk about the income statement model, is basically trying to project the company's revenues and expenses over a specific period. That's what we're doing for income statement, projecting revenue and expenses. When we talk about the balance sheet model, we are projecting assets, we are projecting liabilities, and we are also projecting equity. Okay, great. So cash flow statement is actually measuring the company's future cash inflows and outflows over a particular period. And I mentioned earlier that the cash flow statement model is a derivative of the income statement model and a balance sheet model. Or in other words, we can derive the cash flow statement from the income statement and the balance sheet, right? For example, on the balance sheet, you'll see cash balances. Maybe 2021, the total cash and cash equivalent of the company is 1 million. 2022, it reduced to 800,000. The cash flow statement tried to explain why the reduction, what happened during the year, where at the end of the year, the net balance of cash is 800,000. So there were inflows and there were outflows during the year. So the cash flow statement gives a breakdown of what happened, right? Now, let's get into the essence of financial statement model. And usually, we want to talk about the transactions requiring financial statement modeling. And when we say transactions, it's not buying and selling as we know it in generic terms. Corporate transactions also deal with the buying and selling, but then buying and selling of companies, investment, right? A company is selling another subsidiary or selling an investment, or this company itself is being sold, or a company wants to raise money from the stock market, or a company wants to get loan from a syndicate of banks. These are transactions, right? So M&A, which stands for mergers and acquisition, divestment, where the company is selling off, and vendor due diligence. These are quite technical terms. Of course, if you are not really playing in the industry, I will have to take my time to explain. So if a company wants to sell itself, or the directors or the shareholders want to sell a company, they are the sellers of that company. So we call them the vendors. The sellers themselves may contract an independent company to come and assess their company in terms of their financial health and other factors, write a report, and make the report available to any prospective buyer, right? So any other investor that wants to buy this company, there is a report available for that investor. For example, if MTN wants to sell Momo business to another company or another investor, excuse me, another investor, so MTN wants to sell the Momo business to another investor or another company, MTN, for example, who contracts KPMG, my unit in deals, to perform due diligence. We will assess the financial health of the mobile money business and produce a report. That report will be made available to any prospective buyer. And that prospective buyer, of course, will use the report to make decisions around whether to even buy the company or not. And that prospective buyer also may use the report as basis for the pricing to determine how much it should pay for MTN's mobile money. Now, this contrasts with buyer due diligence. With buyer due diligence, the prospective buyer will contact an independent company to conduct due diligence on MTN Momo, right? So MTN Momo will set up a data room, will provide all the information for prospective buyer consultants to perform the analysis and produce a report, which they call the buyer due diligence report or the buy side due diligence report. And then this report gets shared with the prospective buyer. Then the prospective buyer will now make decisions. Now, the prospective buyer consulted this so-and-so company, let's say KPMG, PwC, and let's say the vendor, which is now the one selling the business, consulted PwC. For example, both consulting firms may come out with different values. They may come out with different opinions because you must work in the interest of the one who contacted you. If you're working in the interest of the seller, you are looking at ensuring that the business looks good in the face of the prospective buyer, so you get a maximum valuation for the business. If you're working in the interest of the buyer, you want to try as much as possible to identify problems so that you can pay lower value or lower price for the business. I think that explains vendor due diligence and buyer due diligence, which I've not included here. But I mentioned that the list is not exhaustive. Vendor assistance too. Now, for vendor assistance, the difference between the vendor assistance and vendor due diligence is that with vendor due diligence, if KPMG creates the report will be branded with KPMG. It's from KPMG, but the vendor assists. KPMG is just assisting the buyer or the seller in the process, setting up data rooms and all that. And any report KPMG may issue may be branded in the company's colors. Now we have joint ventures. They're popular terminologies. We have IPO, which is initial public offering. If a company is getting to market for the first time, there is a need to project the company's performance and also price the shares that they'll be issuing, and it calls for financial modeling. If you are to take a company private, meaning the company is currently on the stock market, you want to delist the company, there's a need for some financial modeling to justify that action. Project and structured funding, there's a need for financial modeling. The banks will need to see the model you are going with. Of course, whether you can repay the debt, they are looking at ability to pay. So you need to do some financial modeling. Private equity investment. Of course, a private equity firm invests in a company, they are portfolio companies. They need to regularly evaluate whether the investment is doing well. They need to do some financial modeling. They need to project the financial statement. They need to come up with measures for EBITDA and all that. And they need to value the investment to see whether the investment is performing well. Fundraising. A company wants to raise funds. This fundraising could be maybe even private placement. There's a need for financial modeling. If being balance sheet restructuring, a company has so much debt, they want to equitize the debt. In other words, they want to convert the debt to equity. In other words, they want to raise equity and use to repay the debt. There's a need for financial modeling. You know why? Because they need to price the shares to know how to get it converted to equity. So the list is not exhaustive, but these are few of the transactions that require financial statement modeling. And so if you want to recommend shares for your investors in your portfolio, you work for an investment bank, you need to do financial modeling because you want to value the companies on the stock market to see which one you think is trading below or which one you think is trading below what is expected to trade. Because companies can be on the stock market and the price on the market may not reflect what you think is the real price or the fair price, right? So to determine whether the stock on the market is undervalued or overvalued, you need to do some valuation, and that implies you need to do some financial modeling. See how important financial modeling could be. Let me check if there's any question. Class duration, please. Oh, class duration. We're closing around 3, right? But don't you think the vendor due diligence is a way of manipulating buyers? That is to gain a higher price in the transaction. Let's assume the buyer connive with the private consultant. In this of like, if I am a buyer, how much value must I place on info received from this consultant in deciding a buyer? Now, the key thing is that in a vendor due diligence, the consultant has a duty of care to the buyer, the prospective buyers. They have a duty of care to the prospective buyer. And the buyers also do their own due diligence. Or sometimes what happens is that when you have the vendor due diligence report, the buyers send it to their consultant to express their opinion on that vendor due diligence report to see whether it's reflective of the true position of the company. So we call it due diligence report validation, right? So there's a duty of care there. Great. Any question? Can you throw more light on M&A? So this mergers and acquisition, if two companies are merged, of course, I think I'm going to explain that a lot more later. How does valuation lead to financial modeling? Oh, yes, to value anything, you need to project the benefits you are likely to gain from it. In the case of companies, to value a company, you need to determine the cash flows that you are likely to gain from this company. So to project the cash flows, you need to do financial statement modeling. And out of the financial statement, you come up with cash flow projections or free cash flows. And I'll do this on the last day. So I'll have that question well responded to on the last day. In the charts, please elaborate on the project and structured funding. Oh, okay. So project funding, if let's say there is, we want to secure funding for the construction of the motorway, and the question is, how are we going to repay the money back? Any development partner that is giving you the money or the banks will say, hey, tell us how you're going to pay the money back. And you see, this could involve several creditors mobilizing funds together to finance to you. So that's more of a structured funding, not just one. They could be in a syndicate of banks or funding partners. And so you need to assess how you're going to pay, ability to pay. So you do some projection. If we construct this motorway over a space of 50 years, and we put tolls on this road, how much revenue are we going to be generating? What will be the operating cost? We project this, discount it back in a way, and that is if you are doing advanced work. But then for the purpose of the bank, you project this and specify the period over which you think the banks will be paid, whether the cash flows will be enough or adequate to cover that. And we are going to be dealing with these things next week. Have too many questions. I need to manage this model the same as structured finance, project finance model. Yes, the relationship is there. Is there regulatory guideline in financial modeling market? Say in account, there is IFRS, in audit. No. There's no regulation. There's no regulation. It's all about best practice. That's why these things operate in the realms of advisory services. There's no regulation. How does valuation lead to? Okay, I think I've responded to that. Now let's move on quickly. Okay, so essence of financial statement modeling for strategic planning. So I explain a lot of these things. So when I get to some of these places, I'll have to jump in. So we can use it for strategic planning. So usually we hear budgeting. A company has a plan to capitalize or capture a market share. They want to evaluate whether the investment they need to make is worth it. So they need to do some cash flow projections. And so also helps in cash flow planning because you want to know whether the existing business will be able to generate enough cash flows to finance the investment you want to embark on. And so financial modeling becomes important. Fundraising, I explained this earlier, mergers and acquisition. Let me talk a bit about it. So if two companies are merging, they want to see what will be the combined position and after the merger, and in terms of how performance will be. So there's a need to do some projection of financial statement and then come up with cash flow projections that you can use to price the merger to determine the share price post-merger. And then with that, you'll be able to determine or also imbibe in that forecast the likely synergies that you are hoping to achieve. Right. Valuation, I spoke a lot about that. Capital budgeting is things that we all know already. NPV calculations and all that. There's a need to forecast cash flows. And to forecast cash flows appropriately, you need to do financial statement modeling. Out of that, you derive the cash flows. Scenario analysis, I explained a lot around this already. Now, because we don't have time, I want to quickly run through these fundamental stuff before we get to the real things. Any question? Because we are getting slowly into the meat of the lecture. Somebody asking, please, can you recap IPOs and private equity investment? Okay, so I talked about IPO, initial public offering, when a company is getting to market for the first time to raise equity or getting listed on the stock market. We need to price the shares. What should be the trading price? We need to price the shares to say, well, this company gets into the market is going to be traded at $1 per share, $2 per share. How do we determine that? So we need to do a valuation of the company, and then we communicate this price to the market. That is the initial price. We intend to sell the initial shares. Private equity modeling, as I mentioned, is more of a private equity firm making investment in companies, call them portfolio companies, and then they need to measure this investment because they have a period over which they intend to hold this investment. After that period, they intend to exit the investment. So they need to keep measuring the investment. So they need to do financial statement modeling for those portfolio companies based on assumptions and based on discussions with management to see if the value at which they intend to exit, they can actually exit at that value, right? Please, will you cover VBA in context of financial modeling? Oh, no, I won't cover VBA. Boss, please, could you encourage participants to use the Q&A function to ask questions? It's difficult keeping track. Yes, please use Q&A rather. And please, can we get a copy of this presentation? Yes, after the session. Answered. Great. How do one get the right assumptions for the online items? Yeah, that's the purpose of the training. That's the purpose of the whole thing we're doing. We're going to spend a lot of time on assumptions, so you don't have a problem. We're still introducing the whole thing. You'll get there soon. Okay. The modeling process and sources of data. Now, so building financial statement model actually involves the following steps I put together. Data gathering. So if you look below here, you see the preparation state, then the model assumption state, then the model development state, then the model evaluation state. So these are the 4-step processes. And next week, when we start building in Excel, you start seeing how these 4 steps are being utilized. So preparation state, then a model assumption, development stage, which I told you is the most important part, then the model development or the building state, and the model evaluation state, right? Okay. Now, so let's look at the data gathering stage. So here, you gather data generally on the company's operations or general information on the company, macroeconomic, market, and industry data, and we'll be getting to look at the kind of data we gather, right? Historical financial statements. So, you as the one doing the modeling, you may be doing this modeling as an employee of a company, or maybe as an investment banker who is evaluating whether to invest in a company or not, or you may be doing this as an advisor, right? So you get a historical financial statement. So when you are dealing with clients, if you're an external person dealing with clients, these are the kind of information you should be gathering. So you come out with generally your preliminary information request list, which you share with the client for information to be provided, right? Management accounts, very important. So budget and actuals and all that needs them. Then pricing and operating metrics and cost data, any assumptions made around pricing and all those things, you need them. Debt and equity funding data. So here for debt data, we're going to get into details of these things, right? But then mentioning some things now, like if they have facility letters, you need them to provide you facility letters. If there are any shareholder agreements on the equity side, you need that. Confirmation of number of shares shareholders own. You need all those data, right? CapEx data. So their capital expenditure, CapEx stands for capital expenditure, budgets that they have. You need this, and so many other information that you need, right? These are the preparation stage. Then we get into the model or the assumptions and projection stage. So for the model assumptions, we looking at general economic conditions, you get information on those things, including interest rate, inflation, exchange rates, etc. And then you look at approach to forecasting revenue and future revenue growth rates. You're going to be deciding on all those things. And this one, the whole thing is big art, and we're going to spend so much time on this one. Basis for projecting of cost of sales. The COS is cost of sales. Then operating expense assumptions. You're going to be developing assumptions around operating expense. So these 3 things I highlighted now sum up the P&L. Then for the balance sheet side, you have to look at investment and financing plan of the company. It depends if you're internal, you have access to some of these data. If you're an advisor, well, you can request for these. But then if you work in investment bank where you are just doing your own side thing, looking at the company as a third party, not communicating with them, you just want to do your own valuation, it will be difficult for you to know their investment plans. Even though by reading the annual report, you may have a glimpse of possible investment they're likely to make in the future to sustain themselves, right? You make working capital assumptions and then depreciation and amortization assumptions, which will, it agrees well with the CAPEX matters. So a lot of time will be spent on this. So when those assumptions are made, then we now link things to financial statement. And I'm going to explain to you when we say assumptions, I'm not saying necessarily typing that so and so will grow as so and so. That is assumption in words. We also have assumptions by here building schedules. It's also called assumptions. For example, if we forecast revenue in tables or whatever in Excel, that's an assumption, right? So if I say assumption, think broadly, not just statements, but also schedules. So once we build assumptions, we link them together into the P&L, the balance sheet, and the cash flow. And we spend time doing that as well. Then afterwards, we evaluate the quality of the output. We will evaluate that against objective. The company wants an IRR of 15% on the investment. As per the model, what IRR are we getting? Is it lower than 15? Is it higher than 15? The bank is saying that before we can give you this fund to do this project, you must get a minimum of IRR of 22% on a project. But the IRR you've come out initially is less than 22%. How do you improve upon an IRR? Now, a lot of work is going to be done. Now, let me say this, that most part of it, you may have to go back to the assumptions again and make changes to the assumption. Then you look at the output. You make changes to the assumption. Then you look at the output. That's why it's a model, self-balancing model, right? Things are well linked. You vary the assumptions and you see the impact on the output. And you get to a level you think, well, this one, the financing parties or the banks or the shareholder or whatever should be okay with this. You test scenarios, you validate your forecast against historicals, there's a whole lot of work. And we're going to see those things on the last day. Now, sources of data. Generally, where do we get data from? Where do we gather data from? I mentioned to you that we're going to be getting into these sources of data stuff, right? Where do we get data from? Like revenue data. So here, I've grouped them into internal sources and external. And guys, let me say this. These are not theoretical things. To me, these are things I do on daily basis. These are the sources I use on daily basis. These are the sources I review on daily basis. So that's why I need to really understand them. I have a lot of colleagues who do similar things I do. These are standard practices. These are practical stuff we do in office on daily basis. These are not theoretical stuff that are not applicable. You know, people say what you see in textbook is difficult to apply. No, not necessarily. So whatever I'm communicating to you, they are practical stuff, right? Good. Now, so I've grouped the data sources into two, internal and external. So when you're coming out with information request list, creating an information request list, that is, if you're outside a firm, you need to create an information request list to send to that firm that, oh, I'm doing, you asked me to do financial modeling for you, or maybe someone asked you to do this business plan for the person. You need information. The kind of, some information you can get yourself open source, but some you may have to contact the client to get information on these things. Revenue from audited financial statement, it gives you information on historical revenue trend. Management account also give you information on revenue. And one good thing about management account is this. It doesn't only give you historical, it also gives you information about the current year, so far what they have done, and the variances. More importantly about management account is that it tells you about variances. And variances help us to assess the quality of management plans, the quality of management planning process. For example, if variance in the past have been very high, it means that management plans and they never achieve it. They plan and they never achieve. So whenever they are giving you assumptions, you must be careful. If they're telling you that deposit will grow by 40%, you must be careful, because ask yourself historically, did they grow revenue by deposit by 40%? If they tell you that, well, they can sell so and so at so and so price, historically, check whether that has been done. So when management is giving you some of these assumptions, you are just opposing these against what happened in history. From revenue side, when we look at where you can get information from external sources, publish competitor financial statement. Of course, if you're a serious accountant or a serious investment banker, you always compare all competitors' financial statement to the one you are looking at. You see, it helps you to ascertain if the growth rate at which this company is growing is slower than competitors' growth rate or faster than competitors' growth rate, and whether that growth rate is sustainable, right? Industry report on revenue. Now, for example, for the banks, you can get this from the banking sector report compiled by Bank of Ghana, or we just have 23 banks in the country. You can put these things together. 23 banks, you can put their financial statement together and get a consolidated financial statement for the industry. And with that, you'll be able to project how the revenues of the banks are growing, how the loan books of the banks generally in the economy are growing, how the deposits portfolio of the banks are growing. So you can use that to compare. And also depends, for example, in the banks, whether you are among the top 10 banks, you're among the top 15 banks. And if you are not part of top 10 banks, we expect your growth rate to be higher. But suppose you are part of the top 5 banks and you are growing at a very high rate, or management is projecting that growth is going to rise. maybe 15%, 20%. But looking at general growth in the economy and growth in the industry, growth is lesser than 15%. Then that becomes an area you need to question. You need market research to forecast demand and price levels, especially for new businesses, new products, and all that. Macroeconomic data is needed on interest rate and all that. We are going to see how that plays a role. That is for revenue, and so many more. For cost of sales, the same audited account, management account, supplier invoices and contracts. And one thing I've forgotten, under revenue, I didn't mention, under internal, customer invoices and order books. So the pipeline, does the company have a pipeline? So you are working as a finance manager in your company and you are doing budgeting. You look at your pipelines. What are the contracts you've signed so far, which are going to play out in the following year? So you are looking at your pipeline and say, oh, well, based on my pipeline, I think revenue is going to grow by so. So we've signed some new contract recently. You work in real estate, you sign some contract. There are some people who have already ordered, right? So you have your order book, and that will help in projecting revenue. Business plans also helps in that, right? Coming to cost of sales, the same thing. But in addition, your supplier invoices and contracts, that replaces customer invoices and order book we saw under revenue, right? And the external source, the same information are provided. Now, for operating expenses, we are looking at same audited financial statement, management accounts, the business plans, and when we come to external sources, macroeconomic data like inflation and all that will determine whether your cost is going to rise or not. Because over the last years, when we were faced with serious austerity, companies have to revise their salaries and all that. Staff costs grew significantly. So based on projections now on the macroeconomy, where do we see ourselves? Where do we see staff costs? Where do we see utility bills and all that? See, those things are dominating our P&L. Competitor operating margins. You're going to see why operating margins are playing a key role. What are operating margins of competitors on the market? Is always different from competition. Now, sometimes when we say industry average, we don't mean the entire industry. You can pick some peers and create your own industry. That these are my peers, these become my industry, my immediate industry. Then you compare performance. Working capital components like debtors, which is receivables, payables, and inventory. Same financial statement. Management account, potential revision to working capital policies. Maybe we are revising our working capital policies. We don't want to sell on credit anymore. Or if we sell on credit, maybe we are allowing only 15 days, not 30 days anymore. We change the policy, right? Or now we're going to be selling online. You pay with your card, you are gone. No sales on credit. Policy revised, it has implications for projections. Business plan have implications for projections. Maybe as part of our plan, we want to maybe be very last when it comes to our policies. Now we want to create more credits. We want to sell extended period. Well, you can pay back in 60 days, or maybe we can sell more. Maybe we've entered into some relationship with suppliers, and we tell suppliers that, hey guys, you should be able to allow us 2 years to repay. Let's sign this contract. Instead of paying 30 within 30 days, can you extend it to 90 days? See, you need to understand that. So you see the question you need to be asking. You see, the financial modeling is not just about picking Excel and start growing things. It doesn't work like that. You need to document your assumptions. You see, now, when we get to CapEx and depreciation, same thing, audited financial statement, management account, business plan, the asset register, the depreciation policy of the firm. External side, publish competitor financial statement, macroeconomic data. Macroeconomic data and what's happening on the industry will help you to know, for example, the extent to which some assets will become obsolete. And you may have to speed up depreciation. Maybe new or innovative methods are coming on board, right? New technologies, where you have to do away with the existing technologies. Maybe you have to move a lot of your things now online. You don't need to work with physical, whatever. And some of these assets may be damaged. You have to be written off and a whole lot of these things. Stand up. And then expert opinion. You are buying a new machine or buying a new plant, you expect to advise on how long this machine can be used, considering your weather conditions, your environmental, blah, 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 your production level, then that will give you some indication of how you should depreciate these assets. As much as possible, I want to cover all the nuances. When we come to the debt side, where do we get information? Audited financial statement, existing facility letters or loan agreement. We need that to get information on how the loan will be repaid. So help us in modeling the loan. Proposed debt funding agreement. Debt repayment schedules. Some banks will provide you debt repayment schedules. So you don't need to do that, but sometimes you can revalidate that. Or sometimes the debt has been restructured. So you need to now look at, if in case we are restructuring the debt, what are the implications? The reason why I need sometimes to get the loan agreement is that in the loan agreement, it may be specified that if you default, these are the penalties. So you now have to model in the penalties. Business plan. Business plan reveals the plans for the future. So the needed debts for the future. Maybe you need to take on additional bank loan. How much is it as per the plan, as per the business plan, as per the investment plan, as per the asset you want to buy? How much additional debt do you need, right? Debt restructuring plans. Of course, if you have plans to restructure the debt, you need to do financial modeling. You need to model the debt based on the terms you believe are most suitable for your cash flow. You present that before the bank, you have a conversation on it. Okay, based on this cash flow, I want us to renegotiate the interest, bring it down to this level for me, or maybe write off part of the loan, or maybe let's equitize part of the loan. The bank now have some equity interest a bit in the business. Provide me additional working capital because I'm in trouble. See all those initiatives. So external factors you need, macroeconomic data plays a key role because to determine the interest rates you think you can get your debt, you must look at what's happening on the market. What is the current Ghana reference rate? Because most banks price the loans based on the GRR, the current or the Ghana reference rate. And Ghana reference rate vividly, it tracks the 90-day, the 91-day treasury bill, right? So you need to understand that. That's the reason why we do macroeconomic analysis. How is the economy now? Interest rates are high because the reference rate is high. You're going to cover all these things. Industry average capital structure. What is the preferred capital structure for the industry? I'll show you where to get that information from. Publish competitor financial statement will give a glimpse of your competitors, the rate at which they've taken their loans, their interest burden. Banking sector liquidity report. It tells you whether there's even money in the country, whether you can get a loan from the banks. Can the banks provide this loan to finance these projects or these real estate projects you're banking on? Can the banks take that on their balance sheet? Do you need one bank? Do you need two banks? Do you need three banks? Can 5 banks finance it? What is the single obligor limit of the banks? Some banks cannot do more than a certain level, a certain amount. They can give to a single customer some more than a particular amount of debt, especially if it has to do with highly risky investment or sectors of the economy like real estate. So you cannot just project that your loan will go and take 5 billion debt. You need to evaluate whether the banking sector can even support. Equity, the same audited financial statement, shareholder records of the shares issued. You need those records. Ongoing funding programs, whether the company is currently embarking on an IPO and or the further public offering. We can call it a further, which is the additional after the initial public offering, the next ones to end up doing or right offering. Companies like going for some right offering or a program like that, a private placement, all that have to be modeled into the financial model. Dividend policy of the company, it helps you in projecting the amount of dividend to be paid. The business plan of the company. Then when we get to external, you are looking at SEC filings. So you can confirm from SEC information on all these things. Stock market reports, SEC produce stock market reports you can use. Analyst report on the company's operations. They also provide good information on what analysts are saying in terms of the dividends the company is likely to pay, or whether there will be share buybacks. Any question? I think that's a marathon, right? If only an audited financial statement are available for a particular period, should we avoid them and wait for the audited ones? Or can we use the unaudited statement till the audited ones are published? Yes. We can use our unaudited ones. But see, usually what I do is that I look historically. I compare the published and audited to the audited over a period of time to see whether there have been significant variances, right? Now, how do you ascertain industry beta practically when data is not available? What sources are available? Is it possible to still estimate it? Yes, it's possible. This is beyond the scope of this, but then I'll treat this the last day, right? I'll show you where we get all these things from, because we calculate cost of equity almost every day in office. Next one. Please, if we have the audited financial statement, what will be the need of the management account? Okay, so for example, if we are currently in June, right? The latest audited financial statement is March, is 2023. Now, if I'm doing projections for the company, I want to know for this year, what have they done so far? From January to the end of May, what had been their performance? We call that current trading. We'll be looking at it soon. So with the current trading, it gives me information about how the rest of the world or the rest of the year is going to be like. I want as much as possible to avoid some terminologies that I'll be defining later. Good. So we need it. And also help us to ascertain management's ability to plan accurately, right? So how are we getting the recording of this class? Well, I think Afri will answer that question. So, okay, good. Now let's get into a very important side. We are getting deep and deeper into the modeling, the start of it. We are still beating about the bush. We are still understanding the environment, right? To know where we find ourselves. Financial statement, how interconnected are they? Now, you can see this kind of like a busy screen, right? So there we see the statement of profit or loss. We see the statement of financial position, and we see the statement of cash flow. Okay. So, and you see the interaction or the interconnection between the three statements. For example, follow me here. If you take the depreciation expense from the P&L, you can trace it down to property, plant, and equipment on the balance sheet. So it tells you that's where the relationship is. Property, plant, and equipment on the balance sheet is related to depreciation on the P&L. If you take interest expense, for example, from the P&L, you can trace it down to bank loan here. You can trace it down to bank loan here. So it tells you that's where the relationship is. If you take after-tax earnings, you can track it down to retained earnings on the balance sheet. Please, this will be giving you, we are going to share this with you, and you take your time to understand the interconnections. You see, when you are doing modeling, you want to know what relates to what. So, what variable relies on which variable, or what's the relationship between them. So, if you have problems in your model, you know how to fix it, right? Now, let's look at it from here. From the relation between the P&L and the cash flow statement, you see an item here, cost of sale. Cost of sale actually translates into some few things here. Land consumed. Of course, just to state, this is a financial model, a sample financial model I developed for a real estate company, right? So they are into real estate, so you see those things here. So you see what cost of sales is relating to. And if you look at EBITDA, EBITDA can be traced to the cash flow statement, EBITDA as well. There, and we have some other items like guarantee fees and those things. Don't worry about understanding the terminologies, the items there. I just want to show you something that there's a great relationship between the three financial statements. And they are one, that's why it's Trinity, they are one, but then there are three in persons, even the one in being. All of you agree with me. But then I will hope you understand what I'm trying to present to you. Okay. Look at the relationship now between the balance sheet and a P&L, and the cash flow statement, additions to PPE is part of property, plant, and equipment. Now, if you look at equity injection under financing activities in the cash flow statement, it relates with share capital. If you look at existing debt repaid, it relates with bank loan. And also, if you look at loans constructed, it also relates with what? The bank loan. If you look at loan repaid, it also relates with the same bank loan, right? Now, so if you look at item like ending cash balance, which is the ending value for the cash flow statement, it relates strongly with the cash and cash equivalents here. Great. I hope that is clear. I have a question here. Please, when modeling for a startup, what other variables can one consider apart from the assumptions made? Oh, we'll get to startup modeling. I'll tackle that. I'm prepared for you. So I have you all booked. We are getting into one of the most important preliminary works in financial statement modeling, historical trading analysis. Here, there are some terminologies that are going to be introduced, and I'm going to take my time and explain these things to you. We'll start with what historical trading is. When we say historical trading, what do we mean? Now, so historical trading, I'm not talking about stock markets. So when we say historical trading, it actually refers to the analysis of a company's past financial performance, focusing on its income statement to evaluate trends and patterns in revenue, expenses, and profitability over a specific period. That is historical trading. So when we say we are doing historical trading analysis, that is what we're doing. Now, back in the university, the most useful or the most popular historical trading analysis we were doing was ratio analysis. Doing analysis of historical data, you do ratios and calculate ratios, and then you prepare ratio reports and all that. But then, in practice, ratio analysis is just 1% of it. There are a lot more that is done. We do the ratio analysis in the context of several things. It's not like a standalone thing we do, right? Now, so I mentioned that when you do historical trading analysis, you're evaluating trends and patterns in revenue, expenses, profitability. So trends in revenue here, you identify trends in sales growth or a decline, seasonality effects, and the impact of market conditions historically, over the historical period. How does those factors affect sales? So you may need to plot some graph to determine whether the company in question exhibits some seasonality. If it exhibits seasonality, that will feed into the assumptions when you are forecasting revenue for the next period. Especially if you are forecasting revenue on a monthly basis, then seasonality becomes a key thing. You see, seasonality doesn't become a key thing if you are doing revenue forecasts on an annual basis. It becomes key when you do revenue forecasts on a monthly basis. But what becomes key for annual forecast is cyclicality. You see, so that's why to ascertain whether the seasonality effect, we do forecast on monthly basis, or we look at the historical trading analysis on monthly basis and do some graph plotting. I'll show you some soon. Cost analysis, here we are evaluating changes in cost of sales, operating expenses, and the impact on gross and operating margins respectively. Profitability metrics, we can assess trends in net profits, like EBITDA trends, and I'll be showing you one soon, and other profitability indicators to gauge financial health and performance. All this analysis must be done before you do your financial modeling, ladies and gentlemen. You don't just start financial modeling by start predicting things and growing things. No, we don't do it like that. You need to do all these housekeeping work first, understanding how history was uncovered. And then you can now think about how the future should be. These things will help you solidify your assumptions about the future. So when you're doing modeling, you have authority over whatsoever you're doing. You're able to justify that before stakeholders. When you're communicating this to the board of directors and the investment community, they're able to agree with you because you have reasonable basis to say that something should grow at this rate, something should grow at that rate. The other aspect is benchmarking, where we benchmark against industry peers and historical performance to identify strengths, weaknesses, and areas of improvement. So we look at other competitors and how they perform. The limitation here is this. When you're working on monthly basis, you are looking at monthly revenue data. You may not have monthly revenue data for your competitors. That's the difficulty. Now, all this difficulty, note them, even the ones you think you face in practice, and I'll share my professional judgment on that. Before we get into this, I want to define some basic terminologies. And you see these terms being used going forward. The first one is the last 12 months, LTM. Anytime you see this LTM, last 12 months, this will refer to the most recent 12 months period for which financial data is available. So the financial data can be cost, it can be revenue, it can be EBITDA, it can be net profit over the last 12 months, irrespective of the financial reporting period. So if a company's financial reporting period ends December 31, okay, meaning it runs from January 1 to December 31. But when we're looking at last 12 months, and we are currently in June, beginning of June, we are looking at last 12 months, it means we are looking at something from 1st June last year to 31st May this year. That is the last 12 months we are talking about. That's last 12 months analysis. I hope that is clear. Then we have another term called year to date. Or you hear things like year to date performance. Year to date, for example, we are in June. So most companies that have well set up system, by now they should have from January to May figures available. So what is performance so far from January this year to May? That is year to date. If we get into July, then year to date will be January to June. If we get into August, it will be from January to August. The other side of year to date is year to go. So if year to date is from January to May, then year to go will be from June to December. So very, very important. Very, very important. Now, when we talk, so why do we do this? For example, if you do the year to go, it indicates the remaining period of the financial year from the current date and to the end of the year. It is used for projecting and planning future performance. So if we know year-to-date performance, you know, look at it this way, guys. The company comes out with a budget. At the end of last year, they have a budget. Pass it on to senior management team. It's get approved. Get it to the board approves the budget for 2024. Now we are in June. We have a clearer view of how 2024 is looking like. We can go back to make adjustment to the initial budget and revise it. So based on the year-to-date performance, we are revising the year-to-go budget, the remaining period's budget. Right? That is not quite something a lot of people find easy to do, though. But I'll tell you the reason why there are problems associated with that. Because all you know, most of the revenues actually came in the first half of the year. So you may think that, oh, since we have done well in the first half of the year, there's indication that the second half of the year will also follow suit. It may not. It may not. And that's a problem with what we call the run rate. The run rate says that, look, from beginning of the year to now, what have been the performance? Based on this, if the company is performing the same way, we expect that the second half of the year also create the same result. For example, if so far, every month, the company makes 5 million cedis revenue over the last 5 months, then we should be getting 25 million in total. Run rate is saying that based on what they did in the past, don't you think they will repeat that in the next 7 months to the end of the year? Every month they'll do the same 5 million. Meanwhile, they plan to be doing 3 million. So based on run rate, we're able to extrapolate what should be the performance for the full year. That's run rate analysis. The last one here, year-to-date completion. Year-to-date completion is an advanced form of the year-to-date. Year-to-date tells the performance so far. Year-to-date completion is the percentage of the budget or the target we have achieved so far based on current performance. So if we budgeted 10 million revenue for the year, and year to date, we have achieved 6 million, then the year to date completion is 6 million as a percentage of 10 million, which is 60%. We have achieved 60% of the budget. I hope that is clear. I think there's some question. Let me respond to it quickly. Okay, someone is asking, is the run rate a component of terminal value and the DCF valuation? Well, I get where you're coming from, but then not necessarily valuation. It can be applied in that sense to also say that over the, and I'm answering you directly so that this is not a valuation class, but let me just answer it directly. When you have the explicit forecast period, after the explicit forecast period, you can assume that going forward, things are going to go as they happened in the past over that period. But then it's not exclusive to that. It's not exclusive to that. This one, we are looking at analysis of cash flow, analysis of P&L and all that. We've not started talking about matters regarding valuation. But even though I'm going to be doing cash flow analysis on the final day, which will feed as an element into your valuation, which I'll not cover valuation, but then I'll cover cash flow analysis. I'll answer that question better. And there's another question. So I think Olamide is asking okay, modeling startup. Okay, I think I've responded to that. Can we assess? Okay, so Grace is asking, how do you analyze revenue of companies listed on the stock exchange on monthly basis since they are only report? Yes, exactly. That's the point I made, that those are some of the limitations of doing monthly data analysis. But then if you are working as an investment banker where maybe you are just doing your independent work, you are not communicating with the company, you may not get this. But then in cases where you are working directly with the company, or maybe you are an advisor to the company, you can request for monthly data if they have. And it's good they have. And most companies have monthly data. Then let me see the question here. Okay, so how different is LTM from run rate? Okay, last 12 months basically is just looking at your performance. For example, I'm going to show you on a graph though. But then what we're trying to talk about is that you have monthly data, right? Monthly revenue via, let's say, the past 5 years. Over the past 5 years. You know the year end is December. But then I'm standing today in June. I want to look at, if I look at the last 12 months revenue, if I sum them together, how much is it? You get a point. So I'm performing the analysis on the last 12 months rather than going strictly with the financial reporting period, year to date December. It must be December. No, look, I need to say this. Maybe that will correct some notion some people also have about valuation. Whenever you do valuation, you can do valuation at any time at all of the year. But many people think valuation date must be the reporting period, which is December 31. No, I can have valuation date being June 30, even though the company is reporting December 31. All I'll do is this. If I have monthly data reported by the company, monthly P&L, I'll reconstruct my P&L back into history by now assuming that the reporting date is June. Do you get a point? June 30. I'll reconstruct the P&L back, assuming reporting date had earlier been June 30. And now I have a new reporting date, which is the date for my evaluation. Then based on that, I'll now present the financial statement of the company, having now June 30 as the reporting date, other than December 31. That's one good thing about the use of monthly data. Someone asking a question, especially with seasonal businesses, hence the reason for a modeler to understand the nature of the business. Yes, exactly. That's why you need to understand the nature of the business. You need to understand the industry because seasonalities could play a key role, right? I like that, Steven. And let me see. I think that is all. So we can continue. Okay. Okay. Now, so let's look at some tools for historical analysis. So historical trading analysis. Let's look at some tools. So data visualization is one. So the use of graphs, the charts and trend lines, and common size analysis as well. where, for example, common size analysis on the P&L, you take each item on the P&L as percentage of revenue, right? And on common size analysis on balance sheets, actually, we take each item on the balance sheet as percentage of total assets, right? That we do. Now, ratio analysis and benchmarking is another one. Of course, ratio analysis, which many of you know, of course, you've been using, so I don't need to talk more about that. Benchmarking is where you compare yourself to your competitors. Then we have what we call the time-based analysis. And I just explained, oh, I forgot one key term, KEGA. KEGA. I was thinking that there's something I've forgotten to include as a tool to define when I was looking at terminologies, right? I forgot KEGA to define KEGA. But run rate analysis, I explained that already. It's a time-based analysis. KEGA is compounded average growth rate. Compounded average growth rate. On average, what is the rate at which the company has been growing? The company's revenue has been growing in a compounded manner. And we are going to get into details of this later, right? And the question is, how good is historical KEGA for forecasting? Now, this is the point with KEGA. KEGA looks at, for example, if I want to calculate the compounded average growth rate over the last 5 years, I look at the last 5-year revenue and the current revenue. Then I do compound interest, right? I want to, you know, the way we do compound interest calculation, compounding, we have the present value, the future value, the interest rate, blah, 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 and compound. But here, what I'm interested in is coming out with the rates, the R. Now, so the intermediate cash flows are excluded, or the intermediate performance excluded. It looks at the earlier performance and the current performance. And so in between, all those performance metrics, profitability, or whatever, even this revenue I'm looking at, is excluded. So KEGA assumes that revenue is actually growing at a constant rate, which creates some problems, right? Even though things create problems, we still use them in practice. We're just careful on how we use them. Now let's get into ratio analysis as a tool for historical trading. And guys, I'm not going to spend time actually on some of these ratios. I'll just show them to you. If you have a question on ratios, any of these ratios, you can put it in the chat, then specifically I'll address that, because these are things that I should assume to some extent that, you know, gross margin ratio, EBITDA margin, anytime you hear the ratio as a margin, it means it's a percentage of sales. That's the meaning. It's a percentage of sales. Now, profitability ratios on that again, capital employed and return on equity. I'll deal with the return on equity more later. Then efficiency ratios, there it tells us about how efficient a business is. Okay, someone is asking a question on operating margin. Now, operating margin tells us the excess revenue over the total operating cost. And total operating cost includes operating expenses and cost of sales. So if a company makes revenue and paid the cost of sales, and book its cost of sales, and also book its operating expenses, what is left, expressed as percentage of revenue, is what we call operating profit. Operating profit sometimes is a good measure of the operating cash flow, or the cash flow derived from a business operations. Operating profit is the actual profit that you make out of the actual operations of the business, right? Day-to-day operations of the business. Efficiency is a matter of how efficient the business is in managing its working capital and also operations. And some of these things like payables, turnover, and all that, we're going to deal with them again when we come to working capital projection. Liquidity ratios measure or trying to track whether the business operations is liquid or the business is generating enough liquidity to finance its operations. Whether the business is making money to be able to repay its short-term commitments like supplies and all that, right? Solvency is a matter of whether the company has good financial condition, and more long-term than short-term. It's not like the liquidity that we talk about here. Liquidity is more short-term. For the purpose of the financial statement analysis, liquidity is more short-term. But then solvency is more of a long-term financial condition. And I want to make this clear. Whenever we talk about liquidity, the meaning of liquidity differs depending on what you're talking about. If it is an investment, it could be a long-term issue. But as far as financial statement modeling is concerned, when we never determine liquidity, we are looking at short-term financial commitment, our ability to generate money short-term to pay our short-term bills, right? But then solvency looks at more of a long-term. Then one thing often I use a lot is the decomposition of return on equity, the drivers of return on equity. So return on equity, I want to mention, is one major determinant of the valuation of a company. There's a very good relationship between return on equity and company value. In fact, the higher the return on equity, the higher the value. And if return on equity is variable, then the value of the company is likely to be variable, right? That's that. And when we take the return on equity, there are two major drivers of that. The degree of financial leverage is one. How leveraged is the company? And the second one is the return on assets. Now, usually you see financial leverage being positive. Usually you see it being positive. But if you have more debt, it increases your financial leverage. Financial leverage is generally, I don't know why I've not placed the formula here. I think it's just one of those things that I've forgotten. But then financial leverage is basically total asset divided by total equity. You see, total assets divided by total equity. And usually what causes the financial leverage to increase is when equity reduces. If equity is low, financial leverage increases. And the possible explanation, the obvious explanation, is that the company is taking on more debt. If a company takes on more debt, it increases financial leverage. Now, let's look at it this side. If the return the company is making on its assets, which is the return on assets, is positive, if that return is positive, then financial leverage will magnify the ROE. So if a company is making good return or positive return on ROE, no matter the level of return, it's just positive, and it has a higher financial leverage, then its ROE will be higher. That's why we have this old saying in finance that leverage magnifies returns. Leverage magnifies returns. However, if the ROE is negative, then financial leverage will magnify negative return. And of course, you can decompose the ROE further into the various components here. ROE decomposition. Still on historical trading, let's get into some few stuff here. What I've shown here is what we call the bridge. This is a bridge. We can construct this for sales. We can construct this for EBITDA. We can construct this for operating profit. We can construct it for profit after tax. We can construct it for anything at all we want to construct it for. What is a bridge? You see, for example, what I've placed here is an EBITDA bridge. This tells us the possible explanations for the movement in EBITDA. What is contributing to positive EBITDA? Or whether the contribution is positive or negative. For example, we may have volume. For example, you have volume driven here. Volume may be driving EBITDA up or may be driving EBITDA down. Margins may explain why EBITDA has risen that year. So look, it's just to say that I look at a particular year and I'm able to say the reason why EBITDA has increased from 4 million to 5 million could be explained by the various drivers of EBITDA, volume, margins, costs, and all that. So which one contributes what? How much did staff contribute? How much did this contribute? How much did that contribute? Some of the contributions may be positive from even cost. Maybe there's a cost reduction between a particular year and another year from one year to the other. And some may be because of margins. Margins have dropped or margins have risen. So we can use that really to understand the main drivers of profitability. We can do for revenue, we can do for EBITDA. If you do for revenue, you may be looking at the major products contributing to your revenue, and you may also be looking at whether price is influencing the quantity or the revenue, or the reason why revenue is rising or dropping is because of price movement. You can see the actual contribution. And on the last day, we are going to come up with a bridge. I'll show you how we construct a bridge. Right. Interesting stuff here. Historical trading, still on it. But here I want us to look at current trading. Current trading tells us about the current performance. You know, we talk about year-to-date performance. That is current trading. How is the company trading so far? How's the company's performance so far? So from January to June, what has been the company's performance? What has been the performance metrics? How has revenue grown? What have been the monthly EBITDA levels? So from January to June, that is current trading. Now, this is what I can do. If you look here, in the current trading, we have year to date, we have year to go, and we have the full year. We also have year to date completion, and we have the run rate. These are all components of the current trading. You get a point? Now, year to date, if I'm in 2020, for example, my dates, I've not updated them, but then suppose I'm in 2023, I can have my year to date to June. Then I can also look at year to date in 2022 for the same period. So if, for example, this 2024, the current or the year to date performance for 2024 will be from January to May. Then I'll compare that to last year, January to May. Last 2 years, January to May. Last 3 years, January to May. You see, in that case, I'm able to really track whether the year-to-date performance for this year was better than last year or last 2 years. So it can also help me to assess seasonality, right? Then we also have year to go. Year to go, if I look at previous years, I can get year-to-date go. I can get the actual year-to-go data. It's just a matter of looking at, okay, so last year, what was the performance, the total performance from June to December? Last 2 years, June to December. Last 3 years, June to December. That information can help me to determine what will be the year to go for this year. So I can go ahead and update my budget and resubmit the updated budget to senior management or to board of directors for approval. To say that based on the previous years, the same period year to go, this is what we think the performance is likely to be. So when we add year to date and year to go, we get a full year. Now, we talk about year to date completion. So if you look at 2019, for example, to get FY 2019 year to date completion, we take 2019 year to date divided by the sum of 2019 year to date and 2019 year to go. Then we get year to date completion. We can do for all the period. Now, so if you see this data here, you see that year to date completion for 2019, 46%, for 2020, 52%, for 2021, 51%, 2022, 38.4%. And if I look at just the last three from 2019 to 2021, they are all hovering around the same thing, right? Yeah. And look at cost of goods sold as well. And look at gross profit year-to-date completion. 37, 45, 43, 39, 43. Now, there's one thing I want you to see. This data, when I was creating it, I assumed COVID-19. If you look at COVID-19 affecting, the COVID-19 was in 2020. So I assumed COVID-19 in 2020. But then you see that the impact wasn't really that great for the completion for that particular year, right? It tells you that the business may be resilient. And if you look at gross profit margin tends to also work in the same direction, right? If you get to EBITDA year-to-date completion, 29%. So it tells you that by the period I'm looking at it, the company was able to do 29% of their total budget or total actuals for 2019. And for the same period, they were able to do only 36% of the total. And 29% here, 35%, 36%. But you see that there's some consistency. The variability is not that huge, right? If you come to EBIT, you see a similar thing there. Then we do the run rates analysis. And all these things, I'm going to provide you some data on the third day, second and third day, we are going to be working on some of these things, real time in Excel, right? Good. Now, one thing I also want to show, the last 12-month trading analysis. I mentioned last 12-month trading analysis. The question is how relevant it is. So here I've plotted some last 12-month trading analysis for revenue and also for EBITDA. Now, if you can see from here, I ran this from, I just plotted generally monthly revenue, right? But this is what I've done, and I want to show you. Sorry, did I say monthly revenue? These are annual revenues, but you need to really take your time to understand what these things mean. Let me explain. If I'm in January 2019, I look at the last 12 months and add the total revenue, and I plot. That's the bar. If I'm in February 2019, I look at the last 12 months, I add the total revenue, and I plot. If I'm in March 2019, I look at the last 12 months, I add the total revenue, and I plot. If I'm in May 2019, I look at the last 12 months. So you see, it's always cumulative in order, right? And I'm able to see this trend at the end of the day. These are net sales, and this is the last 12 months sales I have here. I think I have to take back my word and explain something further so I don't make a mistake. Guys, forget about what I just said. Let me explain this to you this way. The bars represent net sales. These are actual net sales on a monthly basis. But the line at the top is the last 12 months, where, for example, I'm in January, I look back last 12 months and I plot. This is the point here. I'm in February, I look back last 12 months and I get the revenue and I plot. So the line above is the last 12-month curve. You could see that there's some form of seasonality in the sales to some extent. But then the seasonality or the variability is more pronounced when we get to the EBITDA, because EBITDA here by then has also included cost of operations and all that. So cost is also playing a key role here, right? Okay, so because of this, you see whether revenue has been stable over time or revenue has been variable, and that affects your assumptions regarding revenue projections going forward. Now, almost closing on this lesson, then we go for break. We want to look at some best practices in financial statement modeling. So best practice in financial statement modeling, these are basic things: standardized formatting. We look at some of these things when we start working in Excel. Dynamic and flexible model, audit trail, document all the major changes to the model, right? So that you ensure model integrity. Consistency with accounting standards. When you are presenting financial statement, there should be consistency. Model validation, of course, get a qualified colleague or supervisor with a fresh perspective also to look at the model for you to see whether it makes sense. Understand the business, and also data quality and integrity, conservative assumptions, separate assumptions and calculations. So sometimes we use colors to separate them, and also document your assumptions accordingly. Any question? Because there's a question you are going to be solving. Let me see the questions I have here. So how do one get the right assumptions for all? Okay, I think I mentioned that. I'm going to address that later. Can we get a slide? Please explain financial leverage again. Oh, financial leverage, as I mentioned, the degree to which the company or, okay, so let me put it this way. So the formula for financial leverage is total asset divided by equity. So if, let's say, your total asset is 10, your equity is 2, then your leverage is 5 times. It means that the company's leverage in terms of maybe the debt they've taken on is 5 times of, equity is 5 times of 5 times of equity get into the asset, meaning that the company is taking more debt compared to equity, right? Compare that to a company that, let's say, have asset of 10 and equity of 2.5, that company will have a leverage of 4. So meaning you have more equity compared to more debt. And the more debt you have, the more leverage you are carrying. The more leverage you are carrying, it means that whenever you get negative returns, those returns get magnified. Did you say financial leverage increases when liability increases? Yes, I said so, because when liability increases, equity reduces, provided asset is still constant. Equity reduces when liability increases, provided asset is still constant. In that case, there'll be more liabilities. And since equity is lower, and a constant asset divided by a lower equity gives you a higher leverage. Then please, will the class recording be shared? Of course. I answered. Come again with a calculation of year-to-date completion. Oh, year-to-date completion. I'll go back there soon to show you before we end this session. Sometimes companies use very different terms on their financial statement, even when it describes the same value. How do you navigate this issue when linking financial statement? Oh, okay. So, well, of course, maybe you have to come clearer on that question on how do we navigate the same. I think maybe if you can bring the question back again, I'll maybe explain further. I'll answer you. Please explain the relation between financial leverage and return on asset. Oh, okay. So financial leverage doesn't have any effect on return on asset. The only effect is that the higher the leverage, the higher your interest commitment. So if you are going to be making higher interest payment, then since return on asset is net profit divided by total asset, if you have higher leverage, meaning higher debt, then higher interest commitment, therefore lower net profit, all other things being equal. So it has some implication on that side, right? Also, is financial leverage the same as capital adequacy? No, no, no. However, in the context of banking, we can look at it a bit like that to say that the reason why you need more equity capital or more capital as defined by Basel is because you are taking on higher risk, which is almost the same as to say higher leverage, right? So it has some relationship to some extent, but no, not direct, not direct, not direct, not at all, not in the straightest form. No. I think someone has even answered. Nicholas has provided some response. Great, Nicholas. All right. I think that is all the questions. And we are going to take some break. We take some 20 minutes break. So it's now 10, it's now 12, 12. We'll get back 12:30, let's say 33, 12:33. But there's a question here, and I understand that you've been shared with some questions, and as part of the things they shared with you yesterday, you see an Excel file with a name AAA, right? With a name AAA Limited, something like that. It's in the Excel file. So the Excel file was shared with you is financial statement of a fast-moving consumer goods company. And there are some ratios, some spaces created for you to do some ratio calculation. So I'll be happy if you can work those ratios out. If you intend to do it over the break period, that is fine. Or do it and share by close of day on those ratios, calculated ratios from financial statement we share with you. Great. When we are back, we delved into, now we get into what? Modeling. We are going to do revenue modeling when we are back. Revenue and cost modeling. And if time allows us, we get into modeling of working capital. Thank you very much. And let's get back at exactly 12:33 p.m. and stay back. Yeah, hello. Let's allow for additional 3 minutes. Additional 3 minutes for others to get back. Just 3 minutes. Yeah. I'm back now. Um, Let me see if any question. Again, for those that want to connect with me on LinkedIn, or someone post something. Hi, Julius. We have a few questions on YouTube. How do you want to go about those? Also, can a member on your team share the slides with me as I prepare the pack to share after the session? Okay. We will do that. For now, that if you can give me the next break period, that I can handle that. Based on that of the YouTube, just a moment on that. So a member of my team will address the questions on YouTube soon. Let me just quickly check that out. So on YouTube, someone is asking, please, a question. How long does it take for the company's book to fully recognize the true value of the company on the market? Well, it depends on efficiency of the market, whether the market is very efficient or less efficient. And in the Ghanaian market here, it can take forever. But in advanced markets, maybe not too long, for that to happen. So when looking at the revenue growth rate, are you saying a company cannot grow beyond the economic growth rate? And why? No, I never said so. I never said so. They can grow beyond the economic growth rate, but then they can't do so permanently, right? Because the company, if you look at the value of GDP, company's profit is also a component of GDP. So if a company is growing, GDP will be growing. You can grow more than GDP when you are actually a subset of GDP, right? Then please throw more light on the IPO I did. Okay, those on the YouTube, how do they get the slide? Of course, the slides will be shared with everyone that registered. Great. All right, so let's get into revenue modeling. So far, we've set the stage for some modeling work to begin. And again, let me say, if I say we are coming to do revenue modeling, for the purpose of the lectures, it's more on developing and validating assumptions, right? How do we develop and validate assumptions? And that is a prime aspect of modeling as it stands now. Let's look at that. So the lesson objectives here, one, we are coming to understand the key sources of data for modeling revenue. We evaluate key considerations in modeling revenue. And finally, we will forecast revenue for diverse entities. Let's start it. Data gathering. We talked about business model before, so I place it here again just to show you that understanding of the business model is key to the modeling of the business. In terms of modeling financial statement, you got to first understand the business model, how they make money. Very, very important. And the industry. Next one, you can do some operational analysis. In totality, we call that SIPOC, right? The abbreviation for that SIPOC. And the S stands for suppliers, S stands for input, P stands for processes, O stands for output, and C stands for customers. Here we are trying to understand the business. We are still gathering data on the business. So if you map out the company's operations in this manner, you're able to know where or what data to gather, right? Now let's look at the supplier side. Here, it allows you to identify any supplier dependency, whether they are depending on a single supplier or multiple suppliers. And this is also very good for due diligence, if you are performing due diligence. And again, you're able to know if they rely on multiple suppliers, it also gives an opinion or some perspective to the assumptions you'll be developing. In terms of the fact that if I decide on multiple suppliers, if a single supplier increase price, I can move. So that kind of like being locked up in a single price is not something that you suffer so much from compared to a single supplier. And long-term contract, it means that you may be locked in a single contract. Then if the company also buys from multiple countries, so here is dealing with multiple currency, meaning it's almost like a multinational to say. So you're able to see, if you map out things like this clearly, you're able to see the functional currency exposure, right? So the exposure of the financial statement to multiple currency. The company imports raw materials from outside or internally, you know the quantity or the percentage of their purchases from outside, a percentage from the country where they operate. So if most of the importation or most of the supplies are actually imported, it means that your projection of cost of sales and all those things are going to be heavily impacted by exchange rate performance. So you need to have some idea about how exchange rate is going to perform, or the currencies are going to perform, sorry. Now, when we get to the input side, like the input analysis allows you to see what the business spends its money on. Is it on people, and which aspect of the people cost is fees, and which aspect of people cost is variable, and the other materials. Of course, these are just general things at place here. And we talk about cost structure, right? And nature of cost and the behavior of cost and all that. What proportion of the cost is variable and what proportion of the cost is fees. So we identify fixed and variable costs to help evaluate the degree of operating leverage. You see that? So the degree of operating leverage also helps. In fact, understanding these fixed and variable costs helps in this particular way that if I'm to grow revenue, by increasing the number of products the company will produce in my financial model, I want to know the implication of cost. Some cost items may not grow in the same or in line with growth in quantity sold. They may be growing in line with another factor, but they're not revenue. And also, if let's say for example, if you talk about a university or a college that has a student population now, let's say 2,000, and the plan is over the next 5 years, you want to grow the student population from 2,000 to let's say 10,000. And then over the period, you have the growth in student numbers. Maybe they are introducing some new courses and all that, and they expect student numbers to grow. We want to know whether all cost items will also grow in line with the growth in student numbers. Of course, some may not grow. For example, well, the campus maintenance costs may not necessarily grow because we are still maintaining, unless you want to expand on the campus. If you want to now get another campus, then you may have to pay additional rent if you don't own the campus. So you see your rent jumping. But then if the 10,000 target or the 7,000 target in 5 years' time can be contained on the existing campus, then there's no need paying additional rent. So that cost will not change. You see, so you need to understand the cost that will change and the cost that will not change. Now, processes. So why do we have to do process analysis? So it allows us to see what activities the business carries out, and the cost of these activities can help with benchmarking. So what kind of activities that the business carry out? Production, after sales support, R&D, sales and marketing. Look at the functions carried out by the company or the various functions within the business, right? Then the total here, it shows 3 different ways of looking at the ongoing cost base of the business. Who the business buys from, that is the supplier, and what it buys, which is the input we have here, and then how much it costs to carry it, business operation, which is the processes. So we have supplier, we have input, we have processes. You know where your cost is coming from, your cost base. Is it supplier driven? Is it input driven? Or is it process driven? Of course, the process side, you see more of the indirect costs, the overheads at the process side, right? Then output. So it allows you to see what product or services the business provides in volume and the value terms. So the volume of each of the product the company sells, the volume they produce, and also how much it costs them to produce those volumes. So it shows different ways to looking at the ongoing revenue base of that business, what the business sells, that's its output, and who it sells to. So, well, you see who it sells to being the customers here you looked at, and also look at the demographics of the customers, and also whether you sell more in foreign currency or you sell more in local currency. I hope you can then see what is happening here. Why I've still been spending time on understanding the business, data gathering. So when you want to ask questions, you want to ask your company, your senior managers questions, or maybe you are outside a company and you are providing a service to the company, you know the questions to ask, the information to request for. These things will help you to do that, to perform all those analyses, right? Very, very important. That's the SIPOC model. Now, data collection. Now, so for the projection, this data collection, data here, it applies to both cost and revenue, right? So financial records, I talk about the balance sheet, the audited financial statement, the money account and all that. Then sales and customer data as well. Like the previous slide, some data will be collected. Yes, that's a good one. But then you may need data also on the external market, right? Then market analysis, competitor analysis and growth projections on the market. For example, in the insurance industry, NIC, that's the National Insurance Commission, issues report on the insurance industry. You can see how insurance companies have performed in terms of their revenues and their profits and all that. The banking sector report is also published by Bank of Ghana, and also mentioned that you can also create your own customized report, right? on this industry. So it gives you some information on what is going on the market. Economic indicators like GDP, inflation, interest rate are also very important indicators you can gather to set input into the modeling. Operational metrics like capacity utilization, inventory turnover, supply chain. And you know, guys, all depends on the industry you find yourself in. The extent to which you have to collect data depend on the industry, right? Business plans and strategies. Yeah, in the business plans of the company, you'll be able to see new plans they have, which could influence the budget for the period and enhance the financial model. They may have, maybe they want to restructure some items and maybe introduce a new product, and also perhaps they have conducted some market study, and that has been part of the business plan as to how the market is going to perform, demand conditions, and all that you can get. External factors, regulatory changes, technological advancement, these are very important. Geopolitical development. Now, if you export most of your product outside the country, and then there's these global issues, wars and all that, US fighting everybody fighting US, you have those challenges there. Maybe some countries are banned. You can't supply things there. You can't buy raw materials from some countries. They are blacklisted, and a whole lot of those things, factors will also affect you, because if you import your inputs from China and China is being banned, what do you think is going to happen? You have to look for another supplier, maybe at a higher cost. So when you are doing your financial projections, you must include in it the possibility of that happening, right? You must consider it. Customer service and feedback, especially for new products that you're introducing, startups, you may need to conduct some initial view of the market, where we call the focus group. So you get customer survey and feedback. And then also for existing companies, you also get customer service and feedback on whether they appreciate the product or service and whether they are okay with the pricing, right? Whether they think the current price reflect the value. So that feed into your plan going forward, whether prices should be revised and the implication on volume sold, right? Then cross-functional collaboration. And so, well, sometimes you need to get information from other functional units. Marketing is responsible for marketing of product. Of course, marketing and sales work together. They can give you information on volume they think they can sell. Then you can also look at the company's own pipeline to see the contract signed so far. And with a sales contract signed and all the supplier contract signed, and you can have indication of what the price is likely to be. Because when you sign a contract, you have locked in. Yeah, industry benchmark. So benchmark the company's financial performance against industry standards. So you have your peers, and you can also do that to see what do you think will be a sustainable growth going forward by looking at what is happening on the industry. I think some question here. Will the recording be shared? Of course, I think that has been answered a million times. Please, the competition of year-to-date completion again. Will the training being certified to qualify for CPD and CPE? I think if you answer that later, for every 1 CD of equity, there's 5 CD of debt. Okay, somebody answered that. That's great. Will please run rates. Will we have access to the link to the task after today's session, sir? I don't know which task you're talking about, but then we've shared that in your mail. Please, are we going to get the live recording? I guess so. We're going to do that. Good, let's continue. Now let's get into it. We talk about data gathering. To model revenue, we need to perform some analysis. So I want us to discuss revenue analysis and modeling. Now, let's get into it. Everything, we want to start from history. Historical revenue analysis. So a company may generate revenue from a single or multiple sources, and we need to know that. So revenues from multiple sources can be analyzed into components by, let's say, geography, business segment, or product line, right? Now, geography means, yeah, we can define geography in several ways. Of course, a company that sells across the world may group usually how the group is America, they have China, they have Europe, and the rest of the world. That includes Africa and Middle East. You see, that can be geographical grouping for, let's say, Toyota, or for, let's say, General Motors, or those large companies, for, let's say, Apple. But then when it comes to business segment, of course, business segment here, if you deal with, for example, like a bank, they have retail, they have corporate, they have commercial, they have treasury, and some other banks may have their own unit as well. So we can look at revenue from each of these segments. Then product line, for every business segment, there may be different products that they sell, right? There may be different products that a business unit may sell. For example, a bank may may sell loans, different types of loan for different type of customers within a retail space, or different type of loan for different type of customers within a corporate space, within a commercial banking space. So for example, for corporate banking, they may even provide, let's say, working capital loan, or they may provide a fixed asset loan, different types of loan product they may have. So there may be multiple products within a business segment, right? So there are several ways we can analyze this revenue. Now, so if we take the geography, for example, you need to categorize the company's revenue into different geographical groupings, which may not actually align with the groupings mentioned on the historical financial statement. I mean, the audited account, you may not have the same groupings as it is there. Okay, so you can rank based on regions, can be based on countries. Look, you can just define your geography, right? Now, segmental, whatever, which also I've explained, and also analysis of revenue by product. So you can do analysis of revenue by geography, analysis of revenue by segment, analysis of revenue by product. Now, here's a question. And they've shared with you a workbook, the question under revenue analysis. Please give me thumbs up if you have received that mail and you also have the workbook. I want you to give me thumbs up. I want to see you. Are people doing? Yeah, people are doing. Okay, so we're going to start some work, right? Now, so the question on TECO Limited, historical revenue analysis, I want us to solve it. And we have 7 minutes to solve it. Just 7 minutes, and we go through it. Solve it and or if you have to write, and put your response in the chat. Let me have your response and address it. So TECO is a leading technology company that manufactures and sells electronic devices worldwide. The company reported detailed revenue information along geography, segments, and product line 2021, 2022, 2023 financial year, as illustrated below, right? So we have the geography, Nigeria, Ghana, South Africa, and others. And also they had for segments and products. So we have the segment, smartphone segment, laptop segment, and smartwatches segment. Under each segment, you see the product. For example, smartphones, you see budget, and then you see mid-range. Under laptop, you see budget laptop, and under smartwatch, you see premium watches. So that's the presentation here. What I want us to do is that I want you to compare TECO's revenue growth of each budget phones with those of each mid-range phones and budget laptops between 2021 and 2023. So I want the first question to be answered, and I'm giving you 7 minutes. Let's start. Now, in 7 minutes, I want to see answers in the chat. So 7 minutes will be exactly 4 or 4 minutes past 1 GMT, 4 minutes past 1. So let's start. So you can open the one given to you, the workbook given you, shared with you. Open the question and let's solve. Good. I hope you're on board. If you have understood the requirements, please give me thumbs up. Let me know that guys are listening and they are ready to solve the question. Good. Somebody gave me 2. Let me have up to 10. 3, 4, 5. I want more actually. Okay. All right. So please, let's solve this. Let's get back 1-4, or let's make it 1-5. 5 minutes past 1. Let's solve it quickly. This is just the introduction. Okay, great. I'm back. So let me see the responses. So looking at the responses, so Daniel, okay, first Uche said budget KIGA is 19%, mid-range KIGA is 9%. TECO had a KIGA of 3% within 2021 and 2023. Budget phone is the highest growing of the three product lines with KIGA of 19% compared to mid-range phones, KIGA of negative 8.7%, and budget laptops 18.3%. Okay, so that's from Daniel. And let me see. Okay, so Daniel is saying that mid-range has KIGA of negative 8.7%, but then Uche said 9. Okay, he put it in brackets, so it's negative, right? Approximately 9%. Great. I see. Great job, guys. Who else has something to share on this? Any other response? Now, so what we're trying to do basically is that we want to understand how to just do basic revenue analysis from one year to the other. Just basic revenue analysis, how revenue has grown and been able to compare maybe 2 years, maybe compare 1 year to the other or multiple years to see. Okay. Well, you can keep your answers coming. Let's look at the other one. How did TECO's revenue break down by geography change from 2021 to 2023? I think there's been some response on that as well. So I want to quickly move from here. Now let's get to approaches to forecasting revenue. Now, when we want to forecast revenue, and I want to state that we are doing this for non-banks. We are going to look at the banks as well. We'll look at a commercial bank, how to forecast revenue for commercial bank as well. Now, so approaches to forecasting revenue. And again, let me say this. Okay, I think I have one from Sarah. Budget is 11.76. Mid-range is 16.7. Hey, since there's some significant variability, is it KIGA or year-on-year growth? Sarah, if you can explain. And what I want to say is that we are actually doing the modeling as it is now. We will start working with SL next week, but then we are doing the modeling. We are developing assumptions for growth. So how do we do that? That is exactly what we're doing now. And so one thing I want to say is that take these things seriously because these are the processes or the procedures we go through, right? Now, once you understand important components of revenue, you must determine the approach for projecting revenue. And the approach you would adopt could either be top-down approach, a bottom-up approach, or a hybrid approach. Now, so when we talk about a top-down approach, look at it, it's actually from the level of the economy. So here we're going to be talking about the GDP growth rates, inflation. You talk about the performance of the sector where you find yourself. You look at the industry sector in that respect, right? If you're a company that deals in international trade, you are going to be looking at the performance of the global economy, geopolitical risk, and all those factors, right? Now, so you are looking at it from the top and it's cascading down. From the bottom up, here you are looking at it from the level of the company itself, looking at the company's product itself, the various products, and asking yourself, at what rate do I think this product is going to grow? At what rate do I think that product is going to grow? Now, there is a way you can combine both the bottom up and the top down together, and that's what we call the hybrid approach. We are going to get into each of these things. Let's get into top down and see how we do top down revenue forecast. Okay, so when we want to forecast revenue, we're using top down. And today you're going to see a lot of this top down, bottom up, top down, bottom up on a lot of subjects. Very, very important. Now, so when we're doing a top down revenue forecast, there are two things we consider, or two approaches we can use. We can look at growth relative to GDP growth approach, or we can look at the market growth and market share approach. Let me take it again. We can look at growth relative to GDP growth approach, or we can look at the market growth and market share approach. They are all types of top-down approach. But just that one is looking at it from the perspective of GDP, the other is looking at it from the perspective of the industry. So the growth to GDP rate approach works like this. Initially, you forecast the growth rate of nominal GDP over the forecast horizon. So where you can get these things from, you don't have to go and sit down and be forecasting GDP. You can get information from Fitch Solution. You can also get from IMF. You can get from World Bank. But some of these things are proprietary information, like you have to pay for them, right? You have to pay for them. You have to subscribe to be able to pay for some of like Fitch Solution like this. You need to pay. If your company has subscribed to Fitch or your company has subscribed to S&P Capital IQ, you can have some of this data from them. Subsequently, you assess how the growth rate of your subject company will compare with the growth rate of nominal GDP. So comparing the GDP to the growth rate of your subject company, you want to see how they compare, how they relate. So one way to do this sometimes is to look at historically what have been the relationship between the growth in revenue and then GDP growth rate of the economy. You can look at it historically and be able to ascertain if that close relationship is there. So we are not saying that, or I'm not saying that you must necessarily use this approach. But then if it's a approach that fits well, then it makes sense to use. Especially for businesses that are cyclical, it makes sense. Now, you can utilize a forecast for real GDP growth to project volumes and a forecast for inflation to project prices. Let me take it again. You utilize the forecast for real GDP growth to project volumes. Then you use a forecast for inflation to project prices. Now, so if like we're dealing with the business cycle where sometimes GDP is down, sometimes GDP is rising, and all that, we have the up and down movement in GDP, which results in a business cycle. If that's the case, then you have to think in terms of percentage points, premiums or discounts, based on the company's position in the business cycle. So now, if you know the growth rate of the company that, oh, historically revenue has been growing at 10%, but then I think that during expansionary periods, revenue will grow maybe 50 basis points above the GDP growth rate, or maybe above the existing sales revenue growth rate, or whatever you can think. Or maybe during the construction phase, you can think otherwise as well. And we're going to be seeing an example on this and see how this can actually be used. Now, for example, I have a question. For example, when forecasting revenue growth for a private college, you might conclude that the college's revenue growth will be 100 basis points above the nominal GDP, right? 100 basis points above the nominal GDP. And so if you know the nominal GDP, then you can then determine what will be the growth rate of the company. But one thing I want to say, usually when we do these things, we don't just conclude that we are done by just putting a percentage point above GDP growth rate. Then I get the sales growth rate of my company and say that I'm done. No, that's just the start of the process, right? You need to provide good justification for why you think the growth should be at that rate. That's the growth relative to GDP growth approach. You get a GDP growth, which third parties provide. You ask yourself, will my company's revenue grow above the GDP or below the GDP? And don't forget, the revenue may not grow above the GDP permanently. At a point, the GDP, the growth in revenue will drop to the long-term GDP and will continue to grow at most at the level of the GDP, because your revenue cannot grow forever higher than the GDP. No. In the long run, we expect the growth in revenue to mimic that of the GDP. The second side is the market growth and market share approach. Now, here, the process begins with forecasting the growth in a specific market. So if, let's say the banks want to forecast revenue, of course, they'll look at the growth in the entire banking sector. Next, they will evaluate the company's or the bank's current market share and analyze how this share is expected to evolve over time, right? Currently, we are part of the top 10 banks in the country, as maybe based on deposits or maybe based on total assets, we are controlling 15% of the market, right? Now, don't forget, you have already forecasted the growth in the specific market. And now you've determined your market share. And whether you think you are going to grow that market share or you are going to maintain that market share over the forecast period, that decision is made. Now, suppose a company is projecting or projected to maintain a 15% market share in a specific product market, and that market is expected to grow from 93 million to 117 million in annual revenue by next year. With this information, we can actually calculate the growth in revenue. Look at this way. We know you are controlling 15% of the market. We know that market is going to grow from 93 million to 117 million. So currently, how much revenue are you holding on the market? It's a matter of multiplying your market share by the total revenue, current total revenue. That's 15% by 93. Now, we were told that the company has strategies to maintain the market share at the 15%. And now, if there is an industry research that shows that revenue for the market will grow to 117 million by end of next year, and the company also maintain the market share, then it means that the company's revenue by end of next year will be 15% of the 117 million. Now, you may be thinking that, well, is this practical? Yes, because their industry research, third-party researches, that gives us indication of the potential growth in markets, potential growth in revenue in a certain market, potential growth in deposit on the market. Or you can look at historical data on the industry and do projections yourself. Now, assuming the company's current revenue is 14 million, which I mentioned by multiplying 15% by 93, by applying the 15% market share to the revenue figure, the revenue forecast for these companies' product will grow from the 14 million to the 80 million. That's what I've just explained. If there exists a predictable relationship between the product market revenue and GDP, then we can also use regression. For example, what I mean is this. If we know, like, for example, this particular market we are dealing with, let's say, we can talk about, let's say, the clothing market. If over time we study relation between the clothing market and GDP growth rate, we can come up with a regression equation, and we use that to be forecasting revenue instead. And I know people who use regression to forecast revenue, especially in the banking sector, it can be applied. Great. Bottom up. So what did we learn? Top-down approach, we can use growth relative to GDP, or we can use market growth and market share approach. The notes will be shared, so you have time to go through some of these things. Okay. I think someone asked a question. I want to be addressing these things so that I don't have to. Please, in simple terms, how does a company determine its market share for a particular product? Oh, okay. So market share is a matter of one way to determine that is to look at your revenue divided by the total revenue of that particular industry. Now, you may not always get, not all companies publish their financial statements. So the ones that publish, you can gather this. Especially they happen to be bigger players. You gather this. For the banks, it's a publicly available information. Of course, all banks publish financial statements. In fact, they are required to do so because they're public interest companies. And with that, you'll be able to gather information on growth and all that. But usually, when we talk about the non-banking institutions and we want to talk about market share, it's a matter of total revenue of your company divided by total revenue of the market. But when we get to the market, the banking sector, usually there are discussions around total assets. Who has the largest asset? Or sometimes the discussion is around deposits. You see? Great. Now, I think, let me check here for the question. Okay, somebody has then done some calculations here. Great. Thank you, Stephen. All right, so let's get to bottom-up approach. The bottom-up approach, there are three approaches to bottom-up modeling. And some may apply to a company, some may not apply to a company. The first one is time series, right? We talk about CAGR, the compounded average growth rate. So what has been the historical growth rate in a company's revenue? We can use that as basis, make adjustment and use to project revenue. And also here it calls for some examination of past data patterns to identify trends and seasonal fluctuations and other patterns to project future revenue. So that's why we did historical trading analysis. You need to do historical trading analysis to understand the history well. So that will give you indication of how the future is likely to be. Okay. Now, we can also use time series, as I mentioned, to execute top-down approach in terms of regression, relationship between GDP and the company's product. So time series is a key method most analysts use or most accountants use in the market. And how they use it is just to do CAGR, year-on-year growth, CAGR, and then they are growing things. That's time series, period. In fact, that is what a lot of you think we are coming to do. Exactly. You are not wrong. Okay, we are going to be doing that. We're going to be implementing all that. Now, the second approach is the returns-based measure. The returns-based measure, usually the banks use that. You see, this measure actually relies on the balance sheet to project revenue. So there are items on the balance sheet that are yielding the revenue. So for example, banks have loans and advances that generate revenue for them in the form of interest income, right? They have investment securities on the balance sheet that generate revenue for them in terms of interest income from investment securities. Okay, so those are called return-based approaches. And we are going to look at how to calculate a bank's or project a bank's revenue as well. Capacity-based measure like real estate, property, commercial real estate, rentals, and all those things are more of capacity-based measures. Of course, it depends on people who rent shops and stores, retail outlets, and all those ones are part of the capacity-based measure to revenue projection. So it's a matter of the space you have taken, the meter square occupied, and all that have some implication for how much they are going to charge you in terms of maybe prices we have to pay. And also, if they expand the capacity, then more revenue coming, provided they have quality tenants to occupy the building. If the tenants are not of good quality, then there's a problem. And number two, the location of the building also play a key role in determining whether this will attract demand. And so if you look at the West Hills Mall in Accra here, the demand is quite low. Several shops have closed, and maybe a lot of people complain about location of the mall, and so compared to Accra Mall, right? West Hills Mall compared to Accra Mall. Accra Mall is located in the center of Accra, different from West Hills Mall that is almost at the outskirts of Accra. So it creates problems. And so the cash flows actually planned or built into the financial model that they use to evaluate the investment before they entered may not be realized. They may not realize it, right? Good. But then, don't you think it's beautiful if we can bring all the three methods together? Yes, we can do. And that is all we call the hybrid approach. So we blend both the top-down and the bottom-up approach. Very important. Now, for instance, we can actually combine the market growth and market share to forecast revenue for individual product lines and business segment. Then we can then aggregate the individual projections to arrive at a forecast for the overall company. You see? So that's what we can do. We use the market growth and market share approach to get the projections for individual products. Then we do the aggregation. Now, that takes us to the second question on the same TECO Limited. And I think this is the last question on TECO. So I want us to resolve or solve this question here. So the financial analyst at TECO forecasted that Africa's nominal GDP will grow 18% over the long run based on 4% real growth and 14% inflation. Now, so you know what is happening. 18% GDP growth, since that's nominal, if we combine the real and the inflation, we get that's nominal. So 4 plus 14 is 18. So with the rising technological advancement in Africa, the demand for electronic devices is expected to keep increasing. The financial analyst predicts that regional sales of electronic devices will grow at a rate of 5% higher than the nominal GDP in the long run. Additionally, the analysts anticipate a linear deceleration in revenue growth for the laptop and smartphone segment over the next 10 years to align with the projected long-run growth of the electronic devices market. The question is the financial analyst using a top-down, bottom-up, or hybrid approach to forecasting TECO's revenue? And based on the financial analyst projections for regional revenue growth, calculate the estimated revenue growth rate for the smartphones and laptop segment for 2024, 25, and 26. So I want to give 10 minutes on this question so we have it solved. So the questions are in your workbook That's the second question under revenue modeling. You see that question here, based on market research. So this is a question based on market research. See the question based on market research, you see that there. So let's have it solved for 10 minutes. It is now 1:25. We are going to be back 1:35. So let's start now. Now, when we are back, we'll look at revenue forecast for startups. Yeah. All right. So where are we? Let me see the responses. So someone said, let me see. 1, 2. Please, where we can access the client. So, okay. Oh no, the slides will be shared with you. I need to have it shared with. All right. So where are we? So hybrid, the current growth rate of the business is lower than forecast for the industry. So maybe I'll peg the growth at 6%. That's from Daniel. Who agrees with Daniel in terms of the growth, whether it's hybrid or not? I want to know who else agrees with Daniel. Of course, it's a hybrid. It's a hybrid approach, right? I agree, right? Someone said he agrees. It's a hybrid approach. I agree. Yeah. Yeah. So Olayinka said he agrees as well. All right. So he's pegging a growth at 6%. But then you see there's some deceleration over a 10-year period to the long-term GDP. Okay, so someone said, Daniel said, sir, please, some of us are meeting valuation for the first time. So if you can kindly assist, because the moment you leave for us to do, we do not know how to go about it. After the answer, then you take us through. Oh, okay, Daniel. Okay, so this is not actually to say valuation. Of course, we say, I think maybe what you want to say is financial modeling for the first time. Okay, so let me take you through quickly. So the approach being adopted here is more of a hybrid, both top-down and bottom-up. The top-down is coming from the fact that we're looking at things from the GDP side of things, right? But then the bottom-up, we are looking at the specific products as well and seeing the performance of the product themselves. But if we're saying that the business is going to grow at a rate of 5% higher than the nominal GDP, we know the nominal GDP is actually what? 18%. So 5% above 18% will land us at 23%. And then we're told that analysts anticipate a linear deceleration in growth rate for the laptop and smartphone segment over the next 10 years to align with the projected long-term growth of the electronic devices market. Now, so this calls for the fact that you have to go back to the previous question and see the growth rate in this market. And then you are told that that growth rate will decelerate to the long-run growth rate of the electronic devices market, which you have computed to be 23%. How? Because you were told that that market will grow 5% above the GDP of 18. So that's 23%. And you were told that the growth, there will be a linear deceleration in revenue growth for the laptop and smartphone segment over a 10-year period to align with the projected long-term growth rate. So if we know the projected long-term growth rate is 5% around GDP, which is 23%, you have to go back to the initial data we had. I mean here, the initial question on the same company here on slide 10. You have to go here and compare the growth rate here to the 23%, right? I believe it's going to be higher than the 23%. If it's higher than the 23%, you expect the growth rate in the market per calculation here to, or maybe the CAGR growth rate you've done here, to decelerate linearly over a 10-year period. So that in 10 years' time, the growth rate of the market will be 23%. But now it may be higher than 23%. But you want that to drop linearly over a 10-year period. That is the explanation for this. But let me say this. We are going to do the actual modeling work in Excel on a bigger case study. These mini case studies are helping you to forecast revenue under different conditions. And this is the best way to addressing them so that we can cover multiple industries. You get it? But then from next week, we are going to have a bigger case where we are going to forecast this for a bigger company, a single company. And all these nuances will be part. You do it in the context of the market. So we are going to combine all these GDP stuff and all that. You see them all at play when we're doing the modeling in Excel. Let me check the questions. All right, so I think there's a point raised here. Please can facilitate shared solution for the TECO question? Yes, of course. I have not prepared solutions to share with you, and I have reasons why I have not prepared solution. This class, I expect it to be because some of the questions require subjective response. There's no objective answer. Some of the questions you'll be seeing soon. So I don't want to get people to think strictly that it must be this value, it must be that value. No, because in practice, it doesn't work like that. That's what I've made it an open-ended question. I think a question, somebody asked a question. I was told that, no, I'm not sure I've seen it. Okay, now let me continue. And if there's any question, I'll get back to it. But then I'll solve it and share with you. I'll solve and share with you. So you should expect that by close of day tomorrow on Monday, it will be shared with you on Monday. Great. Now, let's get into something more interesting. Let's look at startups. So when you are forecasting revenue for startups, there may be additional consideration for startup revenue forecasting. Now, so when we handle startups, usually you need to do some market research. So I have to conduct a thorough market research to understand the potential demand for the product. And you can validate the business idea with potential customers and assess the potential other levels customers are willing to pay or they are willing to take and pay for, right? Then you may have to get some traction or early sales data. So if the startup has already made some sales or gained traction, you can use this data as a starting point for revenue forecasting. So here you analyze the growth rate and patterns from early sales to extrapolate future revenue projections, right? Because usually they'll do these focus groups and also do some early sales just to see how things are moving like. And so that data is there. Of course, that data set as a starting point in projection of revenue. When it comes to pricing for the startup product, you can begin the pricing decision by undertaking detailed cost build-up. So you look at the various elements of cost, you're able to plan the cost and then you build them up, right? For each of the unit of products, and also if it has to do with service, the cost of providing a unit of the service, right? So this was so that the business cost structures are considered. That's why we talked about cost structures earlier. You then sort data on competitor prices and specifications to evaluate the suitability of your prices, whether your prices are within that of competitors. Sometimes when we do with startups, we don't really have close competitors with startups. So that particular option may not be available for you to do. So early sales reports will also provide some data on potential range of prices customers are prepared to pay for your product or services. So that is the starting point. So the competitor analysis I mentioned, you could do it if you have the competitor data. So then assumptions and key drivers, how do you handle this stuff? So you clearly identify the key drivers that will influence your revenue growth. Well, for instance, you may be looking at customer acquisition rate, the pricing, you go with the customer churn, the repeat sales. These are all critical factors to consider. So you can actually make well-founded assumptions about these drivers based on your market research and industry benchmark. So this is where you gather information from for the startup modeling. And macroeconomic factors are also very important. They could also impact revenue, the direction of the economy, depending on the product you have designed or the product you've developed to sell. So these are just considerations in revenue forecasting. As I said, you are going to see these things more at work in Excel. But you see, we can't jump straight to Excel without understanding what we're doing. Otherwise, you get locked. You won't value. You have several unanswered questions. Now, so what of new projects? Suppose the business is already running and you want to embark on new projects. For example, let's say a hospital, a private hospital are operating, and now they are setting up a new unit to focus on maybe a particular disease or treatment of a particular case, maybe cancer or whatsoever. How do we forecast revenue from those new projects. Now, the first step is to review the strategic plans for the hospital or for the business in question. So you can begin by thoroughly examining the company's strategic plan and initiatives. So these plans may include market expansion, product launches, and all those kind of things you see in the plan, right? Now, the next thing will be for you to understand the timelines and potential impact of each initiative on revenue. So maybe it may take a period for construction to be completed before then revenue starts. So you know when to start projecting revenue, when the revenue from the new project will start hitting your P&L. You know exactly based on the timelines in the business plan. And also, so for each strategic initiative that I sort of just explained, based on the timelines and all that, you're able to determine revenue. So you incorporate the timelines, blah, blah, blah. I just summarize everything that is on the screen here. You have the notes, so you have some time to go through as well. Then you can also consider risks and constraints in the forecasting. The probability of you not getting a revenue could be due to the fact that the regulatory approval may fail. Maybe you want to, a pharmaceutical company wants to introduce a new drug. The regulatory approval may fail. There may be changes in regulation. Let's say mobile money business at a point, you have to have some startup capital and all those kind of stuff, right? To run even something small in your backyard. But regulations may change that may impede your ability to get the revenue you are expecting. Scenario analysis becomes very important for you to develop multiple scenarios about how you think revenue will be. Okay, what if revenue grows, or what if the economy unfolds like this? I expect revenue to grow like this. If, let's say, everything goes like this, I expect revenue to go like this and all that. We are going to see all those scenarios in cases later from next week when we start building in Excel. Now, you can then align with overall forecast. And so you got to align your forecast with the strategic plans and all that to see some consistency between your forecast and also the strategic objective of the company in terms of their financial objectives, such as the profit target they have to the end of the year and all that. Right. A lot of theories, but not theoretical as you may think, too much of theory. Then let's get to the next question here, which focuses on incorporating future plans into projections. And I want us to have this also solved. And please, I want you all to participate in solving this. Today, we are doing a lot of this theory because it's going to form basis for the Excel work we will be doing later. If you don't participate in this class here, it will be difficult for you to really, really follow when we start putting things in Excel. Putting things in Excel is easy, but understanding how we come up with assumptions is the most important thing. So it's currently 1:48 GMT. I'm giving 10 minutes again. Let's solve this question here. So in your workbook, you see it, forecasting revenue, incorporating future plans. Please, if you can hear me and you're ready to solve the question, let me see your thumbs up. I want a lot of hands. I want a lot of hands. I want to see several hands up. Thumbs up. I want to see several hands up. Okay. All right, Emmanuel. Let me see some thumbs up. Okay, great. All right, guys, so let's solve this question here. It's now 1:49. Let's say exactly 2 o'clock. Exactly 2 o'clock. Let's do justice to this question. Quickly, guys. Exactly 2 o'clock. These are real things we face in practice every day. Real issues we face, real questions we face in practice every day. So 2 o'clock, let's be done. Let's start it now. So you see the question also in your workbook. Outdoor arts. Let's do that. Okay, right. So I'm back. All right, so let's look at the question together. I could see several responses. Wow. Great responses. The workbook, please check your email or just scroll the chat you see. Some of us, it's our first time. It's challenging, that's true. But of course, after this, you can, since this is being recorded on the YouTube, you can look out for CFA Society Ghana YouTube page. Is your YouTube page or the handle, and then you will be able to have access to the lecture. Let me see. All right, so 2024, 2025 revenue projections. All right, so this from Festus, and then Festus just presented this in table as well. Wow, that's quite diligent. Then from Daniel, assuming no growth in existing revenue, and that growth will only come from the new initiative projected revenue. I love the assumption. But then you have made that assumption. But the question I want to ask, Daniel, is, do you really think that assumption is true? Okay, so I'll show you something soon. Victor, sales growth rate 13.4%. And 13.4%, I don't know where the sales growth rates that Victor is talking about. Then Uche, 24, 55, 63. Oh, it would be great if Uche and Victor provide some basis for the growth. I first to assume that the revenue growth for 2024 was the same as that of the prior year. Okay. So Festus is assuming a one period growth, the YY year-on-year growth for the previous year. Uche assume growth rate of 15%. Then Philip assuming no growth in existing revenue, and that growth will only come from the new initiative. But please, can someone reshare the link to the question? Assume that the blah, blah, blah. When do we use YY growth rate or CAGR? Then, wow, great responses. All right, so guys, this is what I want to do, right? Let me show you what I want to do. Just look at this for me. For me, I'm not looking at whether that calculation you've done is correct or not. It's a question of whether you can defend it. But one thing you can do first is to do some historical analysis. So what has been the growth in revenue from 2020 to 2021, from 21 to 22, from 22 to 23? Okay, so I calculated the average growth rate from 2020 to 2023. Was that figure correct? If you have your figures there, you realize that between 2020 and 2021, revenue grew by 22.78%. 2022 to 2021 by 19.42%. Then in 2023 by 16.02%. On average, if we just average out the year-on-year growth, we have 19.41%. And then if you do a CAGR, it's 19.37%. CAGR gave us 19.37%, while the average for the YY gave us 19.41%. So if you check it clearly, the points made by Victor, if you check it clearly, you see that even though the YYs are higher than the 13%. Okay, you missed the data. Great. You missed the data, right? All right, so one thing you can do is that when you do that, I've arrived at a CAGR of 19.37% historically, and then I can assume that if no new initiative, I can just make a simplified assumption that if no new initiative, then revenue will grow at 19.37%, which is the CAGR. I would love to go with the CAGR. And I'll explain. You see, we can use the CAGR as a starting point. When we are done building the model, we then evaluate whether the CAGR makes sense. So you now start thinking about competitors coming into the market. You now start thinking about the macroeconomy, whether that CAGR we realize historically is too suitable for the future. But then it makes sense to start building with a CAGR initially, right? So somebody can also use the average year on year, but then you see, the average year on year is slightly above CAGR. Average year on year is giving us 19.41, while CAGR is giving us 19.37. You can try that to see, right? Okay, good. Now, when we look at the, well, I love this. I love this. Who did this? Somebody actually put all this together. That's beautiful. That's beautiful. That's beautiful. And let me see whether I can project it. I think it's in the chat. So thank you very much. Let me share this screen quickly. So someone put this together. I think George, right? George. So put this together. And so it's looking at revenue. So just look at it. The growth has been this. You know, I told you we have great guys on the call here. See, that's so wonderful. So you're wondering that this simple question we have, someone has gone to SLM, get this presented. I love this, and I want to encourage more of this in the future, right? So outdoor arts have been growing. That's a existing product line, has been growing 23%, 19%. Then we move to 16%, 19%. Then I think 60%, 2023, that ends it for the historical period. So the historical trading is from 2020 to 2023. Then the question is going forward. So what he did, I believe George did, was to take the CAGR, either the CAGR or the average of the history, and that is 1919. So the reason why he forecasted 2024 19 and 2025 19 is because the revenue from the new project, I believe, will be coming in 2026. Let me just run that quickly and see that. So what we have here, the fact we have, okay. Now the fact we have, we're told that rollout of cutting-edge digital display technology in prime location across major cities and regional cities. The revenue from this initiative is expected to commence in 2025, amounting to 5 million. Oh, there's a bit of problem. With an estimated growth rate of 15% annually. So this 5 million will be growing at a rate of 15% annually. That's the revenue from the new product. This growth rate is independent of the existing revenue line, right? Now, that is for the digital expansion, 15% growth. Then for strategic partnership, collaboration with local businesses to create targeted advertising campaigns. Revenue from this initiative is expected to start contributing in 2025. Again in 2025, amounting to 2.8 million and grow at 10% annually. The above estimates are based on recent contracts being signed with existing and prospective customers, which I told you, these are pipeline projects, the pipeline contract. So by talking to management, you're able to uncover the pipelines, right? Let me go back to what he produced and share my screen on that. Okay, good. Showing now. Now, so digital partnership, we said that the growth will start from 2016, the revenue start from 2025, but will be growing at 15%. And strategic partnership will be growing at 10%, right? So these are the growth assumptions that he summarized here. And then for the revenue numbers coming here, we were told outdoors, well, of course, these are the historical figures for outdoors. We have 28, we have 34, 41, 47, and 50. And then we up to 47, right? Then he started growing it at 19%, which is right. It grew 47.8 at 19%, and that gave us 57.08. Grew the 57.08 at the same 19%, that gives us this. But my challenge is why he dropped the rate from 19 to 18% for outdoor. I was thinking at least the best measure should have been a constant. And I want to say that it was a mistake you made with this. You wanted to actually maintain it at the same 19%, right? So that is what is done here. So we continue to focus the digital, the outdoor arts based on historical CAGR. That's the focus. Then the digital expansion was done based on the 15% what we have estimated to be the growth in the future, 15%. Don't forget that the 2025 figure was 5 million for outdoors, I think this is where there's another mistake from here. I think one's supposed to be for digital expansion and the other supposed to be for strategic partnership, right? So there's a bit of a mistake here. The strategic partnership supposed to be the 2.8 million, and digital partnership supposed to be for expansion supposed to be for the 5 million. So the naming you have given here is not entirely correct. Then the projections are based on the assumptions I give you. So at the end of the day, we have the total forecast revenue, which is 75.9. What am I saying from? So 2024, we have 57.08. 2025, we have 75.9295. We have 89.63. We have 105.63 and going. So I think this is a good work. This is a good work. I love this. I love the resilience placed into this. And that's coming from George. George, thank you very much. And we have Benjamin too, doing some great job here. Of course, Benjamin to have done it. That's great. That's great. Guys, going forward, I want to see more of this, right? I want to see more of this, including people who are doing elsewhere and typing the result. That is also great. And if you can do it in Excel too, that is also great. So let's continue. Now, one thing I want to talk about is this, guys. Let me see something here. Okay, one thing I want to talk about is this, and I want you to get it. If you look at the growth rate, let me share the screen again. If you look at the growth rate, we are looking at, let me get the charts. Then I think I've been working with that of George. So let me just pin that and then use that to explain something to you now. Now look at the growth rate here, guys. If you see the historical growth rate in outdoor ads, we have the YOY, we have 23% here. Then it dropped from 23% to 19%. Then it dropped again from 19% to 16%. You see what's happening? Who can tell me what we should do? So here in this context, I want you to put a comment in the comment box. Tell me whether the use of KEGA is proper, because revenue is growing but at a declining rate. So what do you think should be done? Because 2021 was 23, 19, 16. What do you think we should do? Should we go with KEGA like that blindly, or you think there's something we can do further? I want to see the responses in the chat. Will KEGA solve the problem, or you think there's something more we can do? Take the average of the historicals. Well, take the average of the historicals. No, KEGA used regression. Okay. So, well, let's look at it one by one. Take the average of the historicals. Well, the average of the historical give us 19.41%, which is even above the KEGA, slightly above the KEGA of 19.37. The KEGA is 19.37. The average of the historical gave us 19.41. But you realize that large figures actually bias measures of averages, right? That's one problem with the mean. Let me see what other people are saying. No, KEGA use regression. Yes, KEGA averages and takes care of disparities in the years. Yes, you see, the disparities are causing me concern because revenue is growing, but then it's growing at a declining rate. So I have a problem there. KEGA will overstay the growth rate for 2023. That's correct. Use median value. We should use median values. Maybe that makes sense. So if we are to calculate the median, let me just do some back of the envelope calculation here on the median. So if we take the median value, we are likely to get 19.42. It's still higher. Okay, so what do you think we should do? Let me see so someone said the next growth rate should be reduced by the trend difference. Okay. But then do you know what is going to happen? You are going to be projecting a downward trend, a permanent downward trend in revenue. Is that what you want to do too? That's from Hillary. And the growth rate should be declining. Maybe we start by taking 2023 and drop it slightly onwards. There is something you guys haven't mentioned so far. No, we shouldn't use KEGA. Okay, yes, KEGA normalizes the difference in the growth. I believe it is a good measure. Oh, well, Angela, that makes sense to say that going forward, the best measure is a measure of averages, right? Compute the declining rate and compound it on the KEGA. Oh, I think that sounds interesting, right? Let's see. We should probably find the average of the rate of decline. We should adopt a hybrid approach. Use KEGA and expected future growth. I love this. I love the engagement. I love the way everybody's thinking. Look, guys, this is the purpose of the class. The purpose of the class is not necessarily sitting by Excel and just doing all this Excel work. You can do it, but then how do we agree? And why not a weighted approach? Okay, all of this makes sense. Now, Evan said, can we use a 4-year? Let me see. Can we use a 4-year moving average? Oh, I see. Possibly. Let us consider all the years bet 2023. That's a great one too. So you are trying to say 2023 may be an outlier. That's the problem. Sometimes if 2023 is an outlier, but then there's something I wanted to mention together with that point you just mentioned. Please, what is the formula for KEGA? Oh, KEGA, in Excel, you can do RRI into bracket. When you put invoke that function, you see what you should put in there. The declining rate should be declined. Okay, maybe you drop it too. Okay, I love the responses, but there's something I wanted you guys to do. Level 2 equity. Yes. I love that. The H model. You wanted to say the H model. We should use the H model instead. Okay, so this is one thing you have all forgotten about. The real thing, all of you are right, but the real thing is investigate why the declining growth. First, why the declining growth? So you know whether the growth will continue to decline, is going to recover. For example, maybe due to the impact of the COVID or the war in the Middle East or maybe Europe or whatever, that could be a reason. So first, investigate it. Once you've investigated and you are clear on your mind and know, well, this is due to the war, then you can start thinking that, oh, maybe since the war is still there, since we still have these geopolitical issues, revenue decline will continue to happen. Maybe that's where you start thinking about, well, declining, or maybe by now you start stabilizing, right? So it's very important to do that investigation as well. But thank you very much so far for the engagement. I love that. I really love it. All right, great. Let me share my screen on the case. I love the way we've discussed this at length. Good. We've done revenue modeling generally for other markets. I want us to look especially at commercial banks. Let me know how many of you worked for banks. How many of you, if you can raise your hand, if you work for banks or any financial institution. Let me see those who work for bank. Okay, Gideon raised his hand. Okay, 3 hands raised. I see. Great. So we have some people here who benefit, even whether you work for bank or not. If you work for an investment bank or maybe asset management firm, and you are following the stocks of some banks, this is also relevant to you. The class I mentioned, let me say it again, will be closing exactly 3:30. We are not exceeding that. It's a 6-hour class a day. My plan is to use 18 hours to cover financial modeling. Advanced financial modeling as designed by us. So modeling commercial banks revenue. Now, first, let's look at the composition of commercial banks revenue. So when we deal with a commercial bank, the revenues, we can group it into two: the interest income and a non-funded income. The non-funded income is sometimes called the non-interest income, right? The non-funded income. Now, interest income can come from two sources: the interest income from loans and advances. So this is like to say, when you go to take a loan from a bank and you are making interest payment to the bank, that interest is an income to the bank and it's an expense to you, right? So that is the bank's revenue. It's part of a bank's revenue. The interest income from loans and advances is part of a bank's revenue. And then the bank also does investments in government securities and all those kind of securities, do investments in fixed income securities, right? So they also gain interest from those investments. So the sum of the interest on the loans and advances and interest on investment securities give us the interest income of the bank. Then we also have the non-funded income side, where we have the fees and commission income. The fee and commission income, because the bank provides services like card services, withdrawals, and all kind of charges. They also provide advisory services, and all those things feed into fees and commission that the bank makes so much money from. Then also we have the net trading income. So the bank's treasury and all the units get into trading. So forex trades, trades in the fixed income market, where they take positions, and depending on the movement on the market, they speculate, right? They speculate, and if exchange rate goes this way or goes that way, interest rate, speculating on interest rate and making money out of that. So that's the trading income. So if you look at it, comparing the trading and the investment securities, for the investment securities, the banks, they buy to hold, usually buy to hold, or in many cases, they hold the investment or they buy it on the account. But then when we come to the net trading income, it's more of taking positions of not speculating on the prices, right? And in most banks. All right. Now, when we talk about quality of earnings, if we do quality of earnings analysis, especially in due diligence, we want to see the proportion of the bank's revenue coming from interest income and the proportion that comes from non-funded income. If you see a higher proportion of the bank's income coming from non-funded income, then we say the bank's quality of earnings is low. It's a low quality of earnings. But then if high proportion is coming from interest income, then we say there's a high quality of earnings. Great. Now, what then drives revenue? So interest income, what drives it? So the amount and quality of loans is key. And if the loans are not performing, so generally, if we take a bank's loans book, we have the performing loans and the non-performing loans. The interests are charged on the performing loans, right? So the loans that are performing that they charge interest on, and interests are deferred on the non-performing loans, right? So the quality loans, which are the performing loans, the amount of those quality loans will influence the amount of interest income the bank will get. And also the level of investment in fixed income securities also drives interest income. And also the general interest rate in the economy also drives that. The lending rate in the economy also drives that. Now, in Ghana especially, because we have people participating internationally, in Ghana especially, most banks price loans at a reference rate plus a margin. So the reference rate usually used is the Ghana reference rate, which is the GRR. So the GRR usually tracks the 91-day treasury bill. All right. So non-funded income here, as I mentioned, is composed of fees and commission income and trading income. The trading income is influenced by trading strategies, trading volumes, and waves on the market, right? Volatility in the market influencing the bid-ask spreads, volatility in exchange rates, and so products and fee-based services, and also other macroeconomic factors. But one thing from my experience dealing with banks is that as the bank increases its deposit books, the deposit mobilization increases, or the amount of deposit grows, you tend to see the fee income also growing. Same thing applies to the loans. Because think about it, if deposit is growing, it means more customers are coming on board. A lot of customers are coming in, so more customers of the bank means that they are likely to be using more of the bank's fee-based services, right? Now, I want us to gain some understanding into a commercial bank. So there's a question there. In your workbook too, you have this question there, and it's on Triple Trust PLC. It's a commercial bank. So Triple Trust PLC is a commercial bank operating in Ghana since 2015. The bank offers a range of services covering retail, corporate, and commercial and treasury operations. Horizon Capital, and you need to get this case because it runs through, right? Horizon Capital, a private equity firm with investment across Africa, focusing on the financial services sector, took a 20% equity stake in Triple Trust Bank 4 years ago. As an analyst at Horizon Capital, you have been tasked with analyzing historical revenue of Triple Trust Bank to forecast its performance for the next 3 years. The summarized profit and loss statement and balance sheet for the last 4 years are provided below. Okay, so now we have the income statement. We're just taking elements on the income statement that correspond to revenue. So interest income, here you see that from Triple Trust Bank PLC's financial statement, I've combined the investment securities interest income and loan interest income to a single interest income line. Then fees and commissions are here. Then we have the net trading income as well. Then on the balance sheet, we have loans and advances. We have investment securities. So I want to hear from you first. So analyze the historical financial statement extract of Triple Trust Bank to identify trends and patterns in its revenue. So I'm giving 10 minutes for us to do that now. Start now. I love the engagement. I want to see more of that again. So just do some analysis yourself and let's see whether we can get some trends in revenue. You can use any tool. You can use ratio analysis. You can use K-Guy and all those things. And let's discuss, right? Great. So 10 minutes. I think there's a question there. Use the method outline. Please, can you do same for a manufacturing company? I don't know what it does. Money markets. Uh, markets. Okay, I think some responses start coming in. Interest income as a percentage of loans and advances and investment securities has been 17% on average, whereas I told you there are people here. Hey, kick off fees and commission and net trading income has been 9 respectively over the period. I told you there are people on the call who will kill everything. Okay, let's wait for the rest. Yeah, some people started pasting some nice things here. Interesting. Yeah. Bafia, I think I'm pronouncing the name correctly. Great one, Bafia. Guys are doing great work, eh? Wonderful table. Wonderful. The bank has shown a strong growth curve for interest income and loans, but net trading income has been volatile, same as investment security fees are recovering. Look, these are wonderful things. And you know, the recordings will be on YouTube. So if you have difficulties understanding some of these things, because you see that people on the call, some people are very advanced on the call here, you can take your time to watch this over and over again. Net trading income, net trading margin evolution. Alexander, your point is great. You made, right? And Mabi said, net trading margin evolution. I don't really know what that's supposed to mean. I don't know what that's supposed to mean. Okay. As I mentioned, in less than an hour time, you'll be done with the lecture. So stick with me. By 3:30 GMT, we are done. Net trading margin evolution. Okay. So let's wait for the rest. Let's give addition. So 3 minutes more. 3 minutes more to finish this. All right, guys, I'm back. And I think it's time now. Let me get I have mine here as well. I've done some bit of calculation. Let me show you that quickly. You have also done yours. Let me show you some few works that my team has done here as well. Okay, so let me open the Excel book. Okay, good. So let me share my screen. Okay, my screen is being shared. So I can see something here. This is from, I think, Barrier or something. Let me see. No. Okay, that was from Bavia. Bavia did this calculation. Let's look at Bavia's work. This is what Bavia did. So I'm showing these things on the screen as well. So when you are watching a video again, you see the works your colleagues have done as well. So balance sheets, loans and advances, Bavia presented here. And year-on-year growth, Bavia calculated the year-on-year growth from between 2020 and 2021, loans and advances grew by 20.91. And between 2021 and 2022, it grew by 27.76. And then it got a CAGR of 19.34%. Oh, good. But then you start seeing what I'm seeing here. Look at the growth, 20.91. It increased significantly to 27.76 and dropped significantly to 10%. But then CAGR is saying 19%. We'll get back. Investment securities dropped by 1.48, drop again by 30%, increase by 35%, negative 2.49. That's the CAGR. And you can see it because there's a drop from 551 million to 511 million. So that drop is reflected in the CAGR of negative 2.49. Now, coming to the income statement, and interest income grew at this rate and at a CAGR of 9.56, and fees and commission growing negative 16 first, then up by 40%, up by 13%, but then in general, 9.93 CAGR. Net trading income grew at YY of 36.2%, then a drop to negative 18%, then a drop again, a negative 38%. Quite bad on the trading side. But then there are good explanations we can provide to this. Let me hold on to that of Bavia and see who else had something here. So we have Daniel. Daniel said interest income as a percentage of loans and advances and investment security has 17.9% on average, whereas CAGR of fees and commission and net income has been 9.9% and negative 11.6% respectively over the period. Great. Let me see. Alexander said the bank has shown a strong growth curve for interest income and loans and advances, but net trading income has been volatile. Same as investment securities, fees are recovering. Well, that's a good observation. Net trading margin evolution, I think it's quite erratic, right? Quite volatile. Volatility in net trading income, that's from Caleb, the most of the three, suggesting exposure to market conditions. So TTB should calibrate their risk exposure. That's a great observation. I have something from Daniel here I want to project. From Daniel, what Daniel is saying concerning the I think it's prepared some presentation. Let me share that of Daniel. So Daniel is saying something interesting here. So Daniel listed the interest income, fees and commission, net trading income, you get a total revenue, and balance sheet, get this data presented here. Now, quality of assets, interest income as percentage of revenue, 52%, 52%, 52%, 57%. So what Daniel has done is that he has taken a total interest income and divided by the total revenue, which is a sum of the interest income and all other revenues. Then non-funded as percentage of revenue, 48, 48, 48. Oh, high quality earnings. I like the conclusion. The revenue growth, interest income has been growing, but this is the CAGR and this is the simple average. So the CAGR and simple average are almost the same. They are the same. Fees and commission, net trading income, blah, blah, blah. Wow, 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 wow. Great job, great job, great job. Who else here? Their quality of earning looks strong. Looking at 2023 figures, that's from Olayinka. That's great. First Tools has also computed funded income, then non-funded income. I think First Tools is doing percentage revenue. Eh? Something similar he was doing, I believe. And First Tools, okay, is gone ahead to do the calculation in Word. Nana Sewa, let me show that of Nana Sewa as well. And then I'll look at mine. Let me look at that of Nana Sewa, then I'll look at mine. So Nana Sewa, interest income, fees and commission, net trading income, then it calculated year-on-year growth, and also CAGR. Wow, wow, great. Guys, everyone is following. I love this. I love the engagement. So at this point, I want to share mine. My team here have done some calculation. I don't know whether okay, good. So let me go to my Excel first, get downloads, and let me share my screen. Okay, so now let me share my screen on some few works the team has done here as well. I hope you can see my screen, right? Okay, great. So we have the same thing, YOY for interest income, blah, 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 loaned, then yield on earning assets. I think we've calculated the yield on earning assets, and the yield on earning assets is actually the interest income divided by the earning assets. And earning assets for a bank is the investment securities plus the loans. They are the earning assets. So the interest income divided by earning assets give us the yield on earning assets. This is the yield on earning asset here. The non-funded income to total income ratio, which you all calculated, and net trading income to non-funded ratio, which you all also have calculated. Now, for the purpose of illustration, okay, we have Uche. Wow. Uche did some great job here as well. Okay, let me illustrate. Let me share that of Uche, and so we discuss that. Okay, so guys, let's look at this. You see that net trading income has been negative. And then we also saw, okay, so let's talk about the net trading income first. What's your thought on that? I want to see in the chart your thought on net trading income. Why do you think we experienced this high volatility? It grew by 36, dropped by 18, dropped by 38. Why do you think we experienced this high variability? I want to see that in the charts. Your responses. What explains the variability in the net interest income? Okay, so wow, Charlie, guys are doing great job. Isaac, wow, wow, wow. The bank's earnings quality is good based on the fact that its funded income is higher than the non-funded income, which even improved in 2023. Okay, exchange rate volatility. Yes, one, because of trading activities. Forex, volatile market. Yes, yes. Yeah, forex trading possibly. Yeah, of course. Yeah, DDP. Oh, wow, I see this. Now, let me show you where the DDP matter comes on strongly. And I'm going to show from, so those watching online who are not Ghanaians, DDP is a domestic debt exchange when the government had to restructure their debt. So a lot of banks have to take a hit who hold position in investment securities. So there is this work done by, I think Bavia did this. Let me see. I want to show his own. Yeah, Bavia's work. And then I'll use that to explain something. Okay. So you all can see Bavia's work now. Now, I wanted to see what is happening to investment securities because I want to talk about that domestic debt exchange program thing. You see that in 2021, the bank's investment in investment securities dropped. And then it dropped significantly in 2022. Yeah, let's just say the banks in Ghana, therefore, say DDP program. Because of that, the bank have to write off most of the investment securities, right? And then things started getting recovered. In 2023, some form of recovery started in 2023. Now, this is the point. When you forecasting a bank's financial statement, if you don't understand how the history evolves, it's difficult for you to determine how the future will be. Investment securities are actually opportunistic like they are based on opportunity. If we see that the market is good, then we allocate more funds there. But usually what the banks will do is that when the banks gather deposits, then they sort out loans and advances and all other matters. Then the leftover is now allocated to treasury or just to get into the fixed income market, depending on the nature of the economy. So you can't just start projecting a bank's investment securities that is going to grow at a certain rate or grow 10%, grow 15%. It doesn't really work like that. If you are growing investment securities, you must look at how the deposit stream is growing. Look at deposit, plan for loan. Then the excess goes to investment securities. And there's a calculation that we did, which also look at the asset allocation, the proportion of loans and advances to the total earning asset of the bank. Over time, the asset allocation also play a key role when it comes to determining whether to how to go about forecasting a bank's revenue. Okay, now let me get back to the lecture notes. I think that's a great one, right? We had a great day, and in the next 40 minutes we are closing, right? I told you close exactly 3:30, so just be with me, stick with me. I think this is getting interesting. Now, let's get to considerations in forecasting banks' revenue. In forecasting banks' revenue, so if I say revenue, I mean those components we looked at. So we can look at the macro side, and also we look at the bank-specific considerations. One thing I want to say, the macro side is important because the bank has investment securities, the bank has loans, and the loans are priced based on the Ghana reference rates. So, or any reference rate, depending on the country where you find yourself in, when you have variable loans. And the interest rate in the economy determine the rate on government or on commercial bank lending as well, right? So it's very important to understand the evolution of monetary policy initiatives. You need to understand the general yield curve as far as government securities is concerned, the treasury is concerned. And also one key thing is the industry borrowing rate. The higher the borrowing rate, the higher the lending rate to a large extent. Unless we can say that there is tough competition on the market, that banks are ready to accept deposits from very expensive sources, but still maintaining a competitive rate when it comes to lending. But well, in that case, it shrinks the bank's profitability, right? Now, the bank-specific considerations, and I want to say this, whenever we're doing forecasting for a bank or building financial model for a bank, I want to understand something. Am I working in the bank or outside the bank? Or can I have access to the details of the loan book and those metrics of the bank? Can the bank provide me that information? Suppose I have access to the loan book. Suppose I have access to the repayment schedules and the interest charges, everything of the bank. Then this is what I can do. The question is, what is the interest rate that I should be using to forecast the bank's interest income? Don't forget, we stated that the revenue or the interest income for a bank, for example, can be determined by multiplying an interest rate by, let's say, the earning asset. And an earning asset here is the investment securities and also the loans. So if I take interest rate and I multiply investment securities or the loan, then I get the earning asset. The interest income. That is correct. But the question is, what interest rate? Now, that leads me to this. Now, look on these slides. If you look at this bank, the bank we've just dealt with, the yield on earning asset is this, 17%, 17%, 19%, 18%. Look at the formula built into this. This is the formula, which is interest income divided by the sum of loans and investment securities, right? That gives me the yield on earning assets, or other people call earnings yield. I had them to be 17, 17, 19, 18. This is a stable yield. You may see it in some banks. If you have a stable yield like this, then we say the bank is good at asset liability management. Liability management is able to keep a stable yield. But that is not the end of the story. There is another thing you can actually consider. However, because somebody will say, well, are you looking at the cost of borrowing as well, the cost of deposits and all that? But then just looking at it on the level of revenue, the liability management policy of the firm, we can say is on top notch. It's top notch because of the stability in the yield experienced over time. Now, with this that we have, if let's say we want to project, the question is, can we use a reliable yield as a starting point? For example, let me show you something. So average yield historically, what are we going to do? Let's try to get the average yield over the historical period. That gives us 18%. It makes sense to say over the last 4 years, earnings have not been volatile. I mean, the yields have not been volatile. Therefore, it's safe for me to predict that going forward, the yield will be at an average of 18%. That's not too bad. But that is, for me, the second method I'll use if the first method fails. And let me show you how the first method is. This is how it goes. If I work for a bank and I have access to the bank loan book, I will assemble all the cash flows of the bank. If I say cash flows, if I deal with loans and advances, so this is what I'll do. I'll get the cash flows in terms of the loans issued out. I'll get the loans issued out, right? Then I'll list all the loans issued out here. I'll list them down. Let's say over the next, let's say some loans, the outstanding loans. If I say loans issued, I mean the outstanding loans. So I'll get all the outstanding loans here. Outstanding loans here. Then I will also get the repayments of those loans. The planned repayments of those loans, of the outstanding loans, right? Follow me carefully. Then I also get the interest income we expect on those loans. So this is to say, let me just copy this and then shift a bit to this side so that, shift a bit to this side. And so I can call this years. So the year. And I call this years. So maybe not necessarily year. I can make it month. But then just for simplicity purpose, let's say years. So I will look for the longest duration loan. Or in other words, the loan with the longest term. If the loan with the longest term so far of the bank is 10 years, then I'm going to do the years up to 10. So I will have up to 10 years. Up to 10 years. That'll give me the loan with the longest 10 years. Then I'll list all the loans that I've given out today as it is now. The loans currently that I've given out, all the outstanding loans now, I put them here. Suppose all the outstanding loans now is about 500 million or 500 something million. Let's just write something like that. Or 500 something thousand. That is fine. That's the total outstanding loans now at the beginning of the year. Then I'll have a repayment schedule for all the loans. Some of them may be 2 years, 3 years, 4 years, 5 years, 1 year, whatever. I will map out the cash flows. Like all loans that are 2 years. In fact, all I'm talking about is what is the total repayment expected from all our loans within the next 1 year. within the next 2 years, within the next 3 years, within the next 4 years, within the next 5 years, within the next 6 years. So let me take it again. I'll take for the first year, maybe we are expecting about, let's say 90,000, this figure there, 90 something thousand repayment. Maybe let me make it, given that this is, the principal, let me just say these whole loans will be repaid, a simplistic assumption, over a 10-year period, right? This is just a simplistic assumption, guys. Because we'll be doing a more advanced work another time, somewhere in the program. So I have this, and if I sum them up together, I should be getting the same figure there. Yeah, I should get the same figure here. Okay, so this is a 10-year period. These are the repayment, and the repayment must be positive. So I should be putting negative by it so that it becomes positive. The repayment are returns to the bank. Now, then I will come up with interest. Here we assume, don't forget, we assume that this single loan portfolio now will be repaid over a 10-year period. Then I'll also look into the bank system, the accounting system, and I'll be able to get the interest income expected this year, next 2 years, over the entire 10-year period from all loans in combination. So let me just put some figures somewhere just to see how these things are working. So just something I'm putting, just some figures. I just want to play with figures, right? So to show you something. So all the interest income things are positive because these are revenues to the bank. These are revenues to the bank. Okay, so these are revenues to the bank. Just want to demonstrate the process, and then we are going to solve real-life questions next time. We solve real-life questions next time. Okay, so we have this. Now, then I get my total cash flow. So total cash flow or net cash flow. I get my net cash flow. So net cash flow. So then the net cash flow, I'll have to sum the things in this order. So I can just do this plus this plus this. That's all. So then I have this as my net cash flow. With this as my net cash flow, how do you think I'm going to be doing? I want to calculate my IRR. So IRR, internal rate of return. I'll calculate my IRR, internal rate of return, of all the cash flows. So I have my IRR function brought here, and I bring all these values here. Then I calculate IRR. What is it? 10%. Do you know the meaning of this? The IRR of 10% is the best measure of the yield on the loans. So if I calculate the IRR of 10%, then I'll compare this IRR of 10% to whatsoever the yield on earning asset is now. But then because I just play with some figures, I may not get exactly this because these are figures I play with here, over here too. These are figures I played with here. But then we get an IRR, and this IRR becomes the interest rate or the average. Let me write it properly. The average yield on bank loans is a better measure of yield. This is the yield. So if you are budgeting for the next 5 years, you will use 10%. You're going to be using 10%. That's the best measure now. You use 10%. Now, I just said this is a simplistic example because in some examples or in reality, we may have to look at the bank's pipeline, the loans they'll be providing, and potential repayment and all that. But here we are just looking at current loans now as it stands and their repayment schedule, period. But an understanding we need to have is that these loans were granted in the past. And when they were granted in the past, the yield or the rate the bank gave to the customers on these loans in the past was reflecting the economic environment at that time. Now the economic environment had changed. Perhaps it has changed. If things are still stable, we are fine. But if it has changed, then after doing this 10%, or I get a rate here, I need to do something more. Let me show you what I will do more. I'll look at the existing or the current GRR rates, and that is Ghana reference rate. And in your country, you can look at equivalent Ghana reference rate. I'll look at the GRR and compare this to the GRR to ensure that this must at least a bit be either at the level of GRR or a bit, somehow more than a little bit above the GRR or just around the GRR. I need something like that. So I'll use the GRR also as guide to determine whether my interest rate I'm using is making sense or not. I hope that is clear. We'll get back to this another time when we are having a full bank to model, and we are going to be modeling a listed commercial bank because we have their data publicly available. So we'll do some of that later. Great. Let me go back to my lecture notes. That's just by the way. Okay. Now that is it. Let's get into forecasting a bank's revenue. Can we look at this question? The screen looks busy. Triple Trust Bank PLC, the same Triple Trust. The same Triple Trust. First, we did analysis of the historicals. Now we want to get into the forecasting. We've already analyzed the history. We've understood the history. Now we want to forecast. Now, you have now been asked to forecast revenue for the bank over the next 5 years. You have gathered the following additional data on the bank, the banking sector, and the Ghanaian economy. The IRR of the bank's banking book cash flows over the last 4 years are as follows. So we've given you the IRR, and what is happening is that this IRR I've just demonstrated to you, they were calculating it every year. So over the last 4 years, this was the IRR. And this was the IRR of the trading book as well, which is the trading book here, I mean the investment securities. The banking book here, I mean the loans, right? So these are the IRR computed every year. Okay, they keep computing it every year since 2020. And these are the IRR. And these are the IRR of the trading book as well. Now, the average commercial bank lending rate over the last 4 years, as published by Bank of Ghana, are as follows. So these are the rates published by Bank of Ghana because these are fictitious rates, guys. Now, we have this also here. Then from your research on the banking sector and after reviewing the sector report from Bank of Ghana, you summarize the following. Let's see what you have summarized. You summarize that for the industry, this is for the industry. You know, we already have these figures ourselves. We computed it from history for the company, but these ones are for the industry. So I'm showing you what you need to be considering when you are doing forecasting. You need this data, you see. So try to give them a glimpse of the things we consider when we are doing modeling. So, you know, I need industry data. I need to be able to, you know, compare something to something. So NFI to total. So NFI is the net funding, the non-funded income, which is the fees and commission and the operating, the trading income, to total income. TI is total income. So these are the ratios from the sector report. Now, the sector loan book grew at a CAGR of 27%. That's another fact you've given us. But I know the rate at which ours grew, right? We calculated it earlier. So the sector loan book grew at a CAGR of 27% over the last 5 years with an average asset allocation, that's loan to investment securities. I wanted to write, loan to investment securities of 55% to 44%. So you can see that the sector is big on loans compared to investment securities. Now, it doesn't mean that a company itself in question may not have a different asset allocation. Sectoral asset allocation has, however, been volatile in recent times owing to the impact of the domestic debt exchange program by the government. Now, you have also summarized the average yield on the government of Ghana bills over the last 4 years. So this is a 182-day bill. that you have here. Of course, I told you that DRI in a way track this money market instrument. So you can use this as approximation for the Ghana reference rate or the reference rates underlying the variable price of loans. Now, based on this, and of course, I think I may be ending with this question. There are some few things to cover again, but then today had been very heavy. I understand because these are key things, but then I also appreciate the engagement. So determine the most appropriate forecast for triple trust banks revenue over the next 5 years. Guys, let's take how many minutes to solve this? Let's take 15 minutes. No, 15 minutes is too much, right? Let's take 10 minutes. 10 minutes to solve this. 10 minutes to solve this. 10 minutes to solve this. So we'll get back by 3:19 GMT. Please, no one should leave. 3:19 GMT, we'll get back. Or let's make it 3:20 GMT. 3:20 GMT, we'll get back. And we'll use the last 10 minutes to discuss the results. Work starts now. Let's do some forecasting, guys. Anonymous participant said, not a question, please. When sharing the slides to our mails, attach the Excel workbook we use for the exercises. T4 times Excel workbook for the exercise. Please, if you can explain, throw more light on what you mean by Excel workbook. And also, which is best? Okay, okay. Okay, which is best practice in conducting a trend analysis? Income items as percentage of loans and or year-on-year growth. Oh, okay, okay. So you're asking whether it should be interest income to a percentage of loans or whatever or year-on-year growth. For me, since the the interest income depends on the value of the loans and investment securities, it's a better thing to do to express the interest income over loans and advances. However, year on year is also important sometimes to just track the growth. So sometimes you can have huge balances on the balance sheet, but they may not really be churning out well. Of course, for analysis purpose, to just communicate a point, year-on-year growth could also be good. So that's why we don't just stick to a single thing. We do all of them and then compare to see what will be the most appropriate. So the question I've even given you, I don't expect uniformity in all the answers, but then I expect you to justify why you are doing what you are doing. Okay, it's time. Let's see what we have. Who has finished? Let's see. Please, can we get solution from first? Yeah. So is it okay to assume a slightly decreasing growth rates considering the economic? No, you see, Alexander, do your work and come and justify. You see, I want you to do your work and then you come and justify your assumptions that you've made. And what do you think? Well, of course. I want you to be able to do your work and then you justify. Well, maybe let me give additional 3 minutes to this because I realize that several of you are not done. And let me give additional 3 minutes to this. We're actually ending with this, right? We are done with revenue. Today has been hectic, of course, because I covered several other things, historical trading and a whole lot of. So next week, we are going straight into cost and handling all those other working capital and debt modeling and all those things. Yeah. So let's give additional 3 minutes. Let's get back 3:25. So we use 5 minutes to discuss. Then we can close the lecture. Okay, so we need to quickly close this. Wow, no response. What is going on? Hey, where is the team? No response. Alexander, you've not projected. All right. No response as of now. Now, indicate if you are still doing the calculation. Just indicate. And I'll be sharing my screen soon on what I'm doing. Okay, Daniel has done something. Daniel has done something. Okay. We'll be sharing Daniel's screen soon. Okay, so I think let's deal with Daniel first. Let's deal with Daniel's own first. Daniel. Okay. So, all right. With that of Daniel. So assumptions. today has not been easy. Yeah? I like the ways guys are working on this item. So assumption, interest income, fees income, and net trading income. So this is the year-on-year growth and percentage of earning assets. So Daniel has gotten this. Well, of course, that's what we did earlier. So from 2020 to 2023 covers the historical period. And then the projections, I believe Daniel, one thing left, of course, he has not documented anywhere as to how he's what he's assuming as the way forward. But then I believe he used the average actually. The fees and commission also average out. I believe he used the average. Either he used the average or he just grew at the 2023. And Daniel may have to explain to us why not negative 16%, why not 40%, but why 13%. And here, net trading income, I could see that he was growing it at the average, which is 10% of whichever. The KIGA is negative 11, KIGA is 99, whatever. These are all based on usually the history we looked at, right? So Daniel may have to explain to us how he projected the loan and how he projected the income statement. He did the calculation, but he has not provided the basis for how these things were done. The loans, the investment securities were projected, the interest income was projected, the fees and commission, nothing like that, apart from the work being done. And also computed some ratios here. So let me check if Daniel is ready to provide us with those information. Okay, while we wait for Daniel to provide that, we have one from Uche. Let's look at that of Uche's work. So Uche so this is what Uche have done. Uche interest income, fees and commission. Uche did some projections and growth rates here I don't know, but then, okay, so YOY, I believe Uche did the forecast based on YOY or whatever. Uche, if you can provide some explanation as to the basis for the forecast, is it based on KEGA? Is it based on YOY? Whichever way it's based on, can you provide us? And then growth rate assumption, interest income, lending rates, treasury bill rates, average funding. Yeah, a bit difficult. We need to know. He took an average. Oh, I see. For the interest income, the rate, Uche took an average of lending rates on the market and average treasury bill rates to project the interest income. Why not the IRR? Is there a reason? I'm not saying you are wrong, but there is a reason why you didn't use the historical IRR on the bank's listing. Is there a reason? Is there a reason? Why not RRI? And then let's look at the next one. Who is ready? Nobody apart from these two. Okay. Now, let me share my screen so I show you something little. I'm not saying mine is superior. No. You can provide justification for why you have done yours as well. And I'm not in any way saying that my calculation is better than yours. No. In fact, at the end of the day, it's a matter of justifying the assumptions we have made. And I've been saying time and time again, There's a matter of justifying assumption. It's not a matter of saying that mine is correct, yours is wrong. No. All right. But if you're not able to provide justification, that's what the problem is. It's now 31 past 3. We're supposed to be closing, but for this last thing I want to show you. Let's connect on LinkedIn. I'm Victor Thunder. There are some people having some LinkedIn connections there. There and there. All right. So let me show you something here. One thing you can do. Now, all right, great. Let's do something here. Now, so we had the history calculated, and we want to be able to forecast the loan book. The thing is this, we know that interest income depends on both the loans and the investment securities. But going forward, I think we have some good information to be able to project the interest income for the loans and investment securities separately. For the loans, you're able to calculate some YOY, historical YOY at a point. Let me see where that is. We did that YOY calculation here. If you can see here, this is the growth in the loans we've computed. And so based on this growth, the question is, do I expect the loans to grow at the same rate? However, I was told that the rate on the market or the CAGR for the growth of the sector loan is 27%. So if the sector is growing 27% and I want to, sector is growing by 27% and my average growth is cut, let me see, my average is, let me see something. That my average growth, I can actually calculate my average growth here, but then I know my CAGR growth is 19%. You see, the banking sector has been growing at 19%. Industry has been growing at 27%. Oh, I'm comfortable to say this bank will grow at 19%, and nobody will chase me because even this growth is lower than that of the industry, right? So I can grow at 19%. That's what I've done. I didn't prepare these answers in advance. My team here was performing some calculations because I wanted to be as real as possible, right? Now, so I have the bank's own CAGR 19%. Then I'm able to project the bank loan based on their CAGR because at least that's lower than the industry. So it makes sense to say it will grow at that rate, right? Now, the question is, at what rate do I think investment securities will grow? You see, investment securities, many times are opportunistic strategic investments, okay? In that, or opportunistic investment, in that it depends on what is available in terms of whether there are resources or excess cash available to place on government securities and whether opportunities are there to take advantage of market movement and all that. Now, so what can we do? We were told in the case that the asset allocation, going back to the case, we're told that the sector loan grew by so and so over the 5 years, and the asset allocation of the industry is 55 on loan and 44 on investment securities. That's for the sector. But then how about for the company? Maybe we need to calculate that. So first, what I do is that I sum up to get a total earning assets. So I get my earning assets. So earning assets. So I get my earning assets. It was calculated elsewhere, but I just want to demonstrate again. I get my earning assets, and that's what I have here. And based on my earning assets, I want to calculate the ratio of loans to and advances to investment securities. So I'm actually interested in that of investment securities. So I look for investment securities share. So I simply do investment securities divided by the earning assets. And that gives me 60%. Now, then let's look at the rate over time. So we have 60% of total earning assets drop to 55, drop to 40, perhaps due to the DDP, then start rising again because now the economy starts recovering a little bit, right? Now, when we look on the market, the sector asset allocation, as I said, this has been computed here, but I just wanted to demonstrate something to you. So this is the asset allocation computed, right? And this is a sector asset allocation, the average asset allocation. But then if I look at the average allocation for the bank itself, it is, let me use appropriate colors, right? If I look at the asset allocation for the bank itself, colors are too deep, is 50%, but that of the sector is 55%. At least it's close to the sector asset allocation. Yeah, we can accept it. Okay, but then this is the point. If I look at the previous year, it's 55. If I look at the sector, also is 55 for average. Well, if I'm moving from 55 to 50, how easy will it be for me to actually move? If I'm committed in long-term government bonds, it's going to be difficult for me liquidating those bonds, right? So if this is the point, I will not say I want to go with average. I'll rather say I want to go with the 55 year, right? But then another question I'll need to ask the bank is, what is your long-term asset allocation? The strategic asset allocation of the bank. Then I'll say, well, if I do the projection, it will be mimicking towards the strategic asset allocation of the bank. The reason why this is important is that the asset allocation will influence the interest income, in that the variability in interest income will be influenced by where you are putting some of your assets. So, well, a lot of companies actually were not affected by the DDP because they saw this coming, right? And they were able to manage their books accordingly. So let's just say 55% represents that of the company as well going forward. So what do we do? To get investment securities, if we know that loans and advances is this, and we know that if 55% is for investment securities over the period, and it means that 45% is for the loan. So if I take the loans and I divide it by 45%, now, let me check something quickly. The 55%, I'm sorry, the 55, so asset allocation for the sector, the 55% is loan. Let's just get that. And so where we have here is actually asset allocation in terms of loans. I need to be clear on this, so there's no mistake. So bank and sector loan. Let me be clear on this. As I mentioned, this is the last thing we are doing. So if I know that this 745 is loans are forecasted, and I know this represents 55% of the earning assets, then it means 45% is for investment security. So I've corrected the error. 45% is for investment security. 55% is equivalent to this figure. So if I divide this by the 55%, which is this, which I'm picking, and then I want to log it. If this is the case, if I do this, it gives me the total earning asset, equivalent total earning asset based on the loan projection. Now, then this total will now be multiplied by that of the investment securities. Investment securities is 45%. But then to link things properly, I'll just do 1 minus what we have here, that of loan. And I have to log that also as well. Then I drag. Now, so this becomes the forecast for loans and investment securities. I never intend to even spend a minute on the time I promised to close, but then for this question, so just stick with me. Now, so this is what we have as a forecast for loans and investment securities. Now, so once I have this, what is the next thing I have to do? The next thing I have to do is to calculate interest income. So I have my interest income. I have my interest expense as well. Oh, sorry. What am I saying? So interest income from investments and interest income from from loans. So interest income from investment and interest income from loans. Okay. Now, this is the point. For interest income from investment, we are giving some few parameters. We're giving the yield on treasury. Now, we have to know whether the bank invests long-term or long-dated bonds or short-dated bonds or whatever. But then a better measure we can have is the 182-day, whatever. But especially in Ghana, because of what is happening, a lot of banks are putting their money more on money market instrument. 2016, 18, 24, 26, 21. Of course, several banks would like to ride on the curve in the short end of the curve rather than long end, because the long end doesn't even exist. There are problems there. So the average 182-day yield is about 21%. It's not bad to use the average at least to do your projection. So I'll come here. Oh, but then there's a problem. I was told an IRR. I was given the trading book IRR. The trading book IRR is 13%. It tells me that the bank's investment portfolios are not entirely short-term. You see, the reason why you may not have to say that, well, short-term rates are higher than long-term rate, therefore that's not correct. No, that's not true. Short-term rate can actually be higher than long-term rate. If you look at the overall book, trading book of the bank, their IRR is 13% average. To me, over the last period, to me, that's represent things better. Because all you know, there are some bonds that longer dated bonds that have lower yields and all that, right? And it's something that is common here in Ghana. So I'll rather use the average for the trading book. I'll rather use the average for the trading book IRR, rather as the best method to forecast this. Because this one, I'm just speaking 182 days. I mean, come on. What if they have 5-year bond, 10-year bond, 15-year bond? You know, now, like, and maybe 182-day bond, day bills actually like just 5% or 10% of the portfolio, right? Now, so I go here and I pick up the average yield, and we are going to improve upon this later, right? For now, just doing initial calculations of how these things work. Then we multiply by the investment securities, there we grow. So then we come to interest income. For interest income, we have some great news here. Number one, we were told the lending rates to be this, the average lending rate on the market. The average yield on earning assets is this, but then this is a combination of both investment and loans. So if investment are projected around 13%, loans must be above this value so that the average will still be around this. Okay. Number two, we were told the banking book IRR is this, average of 23%. For me, these rates are not that different from the lending rate on the market. It's similar. To be on a safer side, I will command around the IRR, and I'll use this IRR of 23% instead. You may be doing something different, but then for some reason, I want to go with this, the IRR here. So I come here and I do the same. So 1 plus, oh sorry, what am I doing? I do the same. I come here, then I log this up, and then I multiply these entirely by the loan. How is it doing? Do you type correct? Yes, correct it. Okay. Then I project. Then I was thinking I was projecting this correctly. Okay, all because I didn't log this, right? Okay. So let me project this now. And then this actually give me the total earning income, interest income. So total interest income. So I've done projecting total interest income, at least for this exercise. Now, I'll be documenting the procedure. I don't just have to focus and forecasting sake. When I'm done, I have to document why I think it should grow at the IRR and not at the lending rate or not at the historical yield. I must be able to provide explanation. Just with this projection, I can calculate something interesting here. I can calculate the implied yield on earning assets. The implied yield on earning assets is actually the total interest income divided by the earning assets. And that gives me 18%. For the first year and subsequent years, we have the figures there. Not too bad. At least it's been consistent to a large extent. Not too bad. Not too bad. And it's like this because the rate of growth too has been constant. In reality, I may not do things like that, but I'll show you where things will change when we start doing things next week. Not that in reality we can do this, but then I'll give you additional insights because of time when we do this proper next time. Now, the next item I want to focus is the fees and commission. Of course, these ones, you can grow them on CAGR basis. You can grow the net trading income too. But then what I try to do or advise you to do is that you have to look at the non-funded income to total income ratio. And maybe you want to maintain that ratio. So I think that was calculated somewhere. Non-funded income to total income ratio is 48, 48, 43, 47. Very, very stable. Very, very stable. Wonderful. So I have this ratio stable like this. And the non-funded income to total income for the sector too has been this. You see, that of the bank has been higher than that of the sector. You may conclude that, oh, it tells you that the bank is maybe compared to the sector, their quality of earnings is a bit impaired or whatever. Whichever way it is, we need to look at the weight of this bank on the market before we can conclude. Whether it's the dominant bank, is it part of the top 10? Is it a smaller bank that is now growing before we can conclude on matters like that? Now, if I know the ratio, I can focus what I think the ratio in the future will be. Now, the average ratio is 47%. If I take this 47% as the average ratio, because of stability, I may rely on the average. In fact, whenever I have stability in historical rates, I tend to rely on the average. So if I take average like this, 47%, what I'm trying to say is that I expect the relationship to be around this 47% going. So if I'm able to forecast the interest income at these rates, then I ask myself, if 47% of total income is for non-funded, then it means 53% will be for income. So if I'm to determine the total funded income, or the total income, that based on my projection, that will be the total interest income divided by 1 minus 47. This will give me the total income. So this is the total income. Now, based on this total income, I want to derive what will be the income for fees and for net trading income. For fees, I can do a CAGR estimate that fees will grow at a CAGR of so and so. So once I don't want to continue, once I determine that of fees in terms of the growth, and I know the projection for fees, I'll just take out fees from the total income. The leftover become the net trading income because it will be very difficult for you to project net trading income. It's very, very difficult. That's why we experience that high variability in history. We are going to cover all these things. Next week or two, we'll get into the meat of this again, and we see how to do this proper. And so I want to stop here for today. When we meet next week, we continue. And I want to check to see if there are any questions for me to respond to. Wow. So interest income is based on historical average of yield, fees, and commission based on 2023 growth rate. Of course, someone said, doesn't the investment securities portfolio comprise mainly of hold to maturity securities? Yeah, it comprises mainly of hold to maturity securities. But sometimes, of course, not entirely hold to maturity. There's no law that you must hold them to maturity, even though you are holding to maturity. You can sell them on the way, right? If you need liquidity. Yeah. Okay. Now, any other question? So I'm done for today. Let me get your impression of today's session. How did you feel? How did you feel today's session? Have you learned something new? Please, if you can type it in the box. I know everybody's tired, actually. If you are still by your machine, I want you to type something. Someone said, Evan said, given the DDP mentioned in the case, I expect future asset allocation to tilt towards loans. Yeah, how would you incorporate the DDP in the forecast? Yeah, the thing is that I'll consider the DDP here as an outlier. And then I think over time, firms will recover. But then the banks are not going to recover ASAP. They're not going to recover ASAP. It will take time for them to align. You know, it will take time. They are not going to get into the bank, the investment securities right away. It will take time for them to move. But then you start to buy the shorter instruments. Then over time, they move towards the longer dated ones. Okay, so I'm getting some reactions. I'm getting some reactions now. So someone, let me see. Let me start from here. Hey, plenty, thank you messages. Insightful, thank you. Insightful, very insightful. Great work, sir. Thanks. Yes, thank you. Yeah, very insightful. Thank you. Plenty new things, very informative. Thank you very much. Packed, but very insightful. Thank you immensely. Excellent and insightful. Very great lesson, and maybe consider the new CRL requirement. Oh, yeah, cash reservation, right? I get it. I've learned a lot. Thanks for this. You were awesome. See you next week. See you too, Patrick. Intriguing, many thanks. The lecture has been quite insightful. Nana, I have been baptized into some interesting stuff. Emmanuel. Jocelyn says, please, can these models be used for remittance company? It depends. It depends. So I think we can address matters like this in the next session. Very engaging, we are grateful, very insightful. Thank you. It's been helpful. Thank you. I hope the recording will be shared. Well, the recordings are on YouTube, so please subscribe to CFA Society YouTube page, and you have all this, the channel there. Very insightful and informative. It is a lot. Thank you very much for the wealth of knowledge. Thank you, but loss at the end. Well, you can go on YouTube and watch. It has been a very insightful session. Thank you so much for organizing this. I thoroughly enjoyed the lesson. God bless you. Meet you next week. Really engaging, and I enjoy learning. This was a great session. Thank you. How will regulatory reliefs for the next year be incorporated in the forecast? We'll get into that when we do the full-blown bank modeling. Thank you, sir. Thank you so much. Hopefully, we look for the insurance industry next. Yes, some few things on insurance coming. Insightful. It's been insightful. Thank you all. Thank you very much for your time. Thank you, Ifriye and the team. And I'm done. So, Ifriye, you can take over.
Yes, Julius. Hi, everybody. And thank you so much, Julius, for the session. Just a few things before we leave. I will be sharing the slides and all the recordings shortly after this session. And we are reminded that we have the second session next Saturday. Within the week, we will share the workbook and materials for the second session. And then we would let you know that. So you can please follow us on LinkedIn and YouTube so that you'll be updated with every information that we have. So enjoy the rest of your evening and your weekend.